This is frankly nuts. Canada and Mexico are our two largest trading partners.
The signals he's sending suggest that he sees values in tariffs above and beyond even their negotiating leverage.
There are near-term inflation effects when you're implementing tariffs.
It could change on a dime, but I think once they're on, then it's harder to take them off.
We think that this could actually be highly disruptive to supply chains, potentially inflationary because of that disruption. This could weigh on growth and inflation in a more meaningful way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Should we get your week started? Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Monday confronting the beginning of a trade war. Equity futures on the S&P 500 negative. We're down across the board. The underperformance on the Russell, the small caps negative by more than 2%. One industry with a major cloud hanging over it, the automakers. Stellantis, Ford, GM trading lower. GM hammered last week, hammered this morning, down by 6.5%. The winner from the weekend's action, the US dollar. The best day for the US dollar since the day after the election. The dollar stronger across the board against the Mexican peso, the Canadian loonie. And Europe's going to get it too, apparently. Euro dollar down to 102.44 and negative by more than 1 full percentage point. At least on that currency pair, the low since 2022.
And parity basically is all but a certainty. That's what people are saying heading into the remaining couple of weeks and months ahead. Key question is, are markets right now fully pricing in the idea of these tariffs that were announced over the weekend sticking? And if not, are they really selling off or being disrupted enough to really act as that check on Donald Trump's policies, as so many people believed that they had a seat at the table? Do they?
So the reaction pieces across the weekend, I'm sure you've all read them at home. The number one question, your question, how long does this last? Is there scope for negotiation? One thing we do know, after hearing from the president shortly before he got on board a helicopter just yesterday evening, was there's going to be some calls later on today between him and the Mexican leader and the Canadian leader too.
That's right. Trump said he's going to be having both these phone calls today, the Prime Minister, Justin Trudeau of Canada, and also the Mexican president. But then he said this: I don't expect anything very dramatic, Jonathan. We put tariffs on, they owe us a lot of money, and I'm sure they're going to pay. So he's saying he doesn't think there's going to be anything dramatic. That basically signals that these tariffs may come into effect, as he said, just after midnight tomorrow. But when it comes to Canada and Mexico, less so China, is there this scope potentially for negotiation? Goldman Sachs overnight said that while the outlook is unclear, they do think this for those two countries will be short-lived.
This to me is fascinating. Basically, everyone's saying this isn't going to be there for very long. Meanwhile, you talk about the U.S. hit. The U.S. is resilient enough to look past this and avoid recession. That's basically the base case. You take a look at some of the projections from Mexico and Canada. George Saravelos called this something that was a magnitude above Brexit for both what we could see for Canada and Mexico, and that it could really force them into recession in the next few weeks and months ahead.
For the markets, remember the pro-growth story regulated by the stock market? Remember all of that? This came from Jordan Rochester of Mizuho. This is the first test of Trump is good for stocks, and we might not like the answer. Equity futures right now on the S&P negative by 1.4%. We begin with our top story. President Donald Trump slapping 25% tariffs on Canada and Mexico and 10% on China.
We may have short-term some little pain, and people understand that. But long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country. Not every country, but almost. And we're going to change it. It's been unfair. That's why we owe $36 trillion. We have deficits with everybody. We help everybody. We've been helping everybody for years. And to be honest, I don't think they appreciate it. So we're going to change that.
So the trade war begins. Canada planning a 25% levy against $106 billion US dollars of American goods. Mexico preparing a response. And China's Commerce Ministry vowing, quote, corresponding countermeasures. The tariff set to go into effect in fewer than 24 hours. Your team coverage starts right now. Bloomberg's Tyler Kendall in Washington. Divya Balji in Toronto. Clayton Harrison in Mexico City. Tyler, first of all to you, a big question for later on today. There will be a series of calls between the President of the United States and the two leaders of Mexico and Canada. What can they do to avoid these tariffs going into effect?
Right, John, the big question, what is the metric of success that President Trump is going to be looking for in order to lift these tariffs? Now, when it comes to reaction here in Washington to what's going on, of course, we've seen allies tell President Trump that they're supporting this because of it will help tackle his immigration agenda and also fentanyl coming over the border. But it's not that easy for all Republicans, particularly when you look at some Republicans that represent top agriculture producing states, such as Senator John Thune, the majority leader, who has said that he would only support tariffs if they were done in a targeted way. I was at Scott Bessent's confirmation hearing on Capitol Hill last week, where another Midwest Republican, Senator Todd Young of Indiana, asked Bessent how he's going to protect American farmers when it comes to tariffs. Bessent said that he was looking into some sort of catch-up provision that would help bring Beijing to the negotiating table when it comes to purchase agreements that they made under the Phase 1 trade deal, which has since lapsed. So big questions there remaining, particularly if these nations can come together when it comes to expanding or addressing these concerns by President Trump.
Divya, when it comes to Canada, we do know that Justin Trudeau announced and promised a retaliatory measure, but it's going to be in a more gradual response. Potentially, is the Canadian government looking for an off-ramp to negotiate right now?
Yeah, I mean, that's what it really sounds like. You know, $30 billion worth of goods right away will be taxed. And then they're going to do a 21-day consultation period to bring on the rest of the $70 billion or more of goods. You know, I think, them having a call today, the fact that there were a lot of Canadian officials visiting Trump and the White House last week, it does sound like they are trying to give some breathing room and some kind of space in order to be able to pull some of this back, or at least negotiate and figure out if anything can really be done. I think the question here really becomes, can something actually be done? Is Trump going to just, stay put and not budge? How much does Canada actually have to, in a sense, give in to the White House and to Trump in order to be able to remove this, if even possible, right now?
Creighton, we're expecting to hear from Mexican President Claudia Sheinbaum later this morning about Plan B that Mexico has to really retaliate more specifically. What are we expecting to hear?
Not a lot of hints beyond that there will be some retaliatory tariffs and non-tariff actions, is a phrase she used. So we don't know exactly what that means. There is some indication, perhaps, that she's talking about some of these working groups that she's been proposing on the border and for security measures between the three countries. So again, that would be more of a conciliatory type measure. So we would expect some mix of carrots and sticks here. It's not going to be, necessarily a wholehearted retaliatory effort, but perhaps some mix of some good and bad.
Creighton, it seems to go further in places like Mexico. And I'd love the response from you, just your thoughts on what is developing there, particularly on the foreign relations side. This is an administration that, as soon as it set foot into the door, went after the cartels and wanted to deem them as terrorist organizations. Then within the fact sheet we saw over the weekend, it accuses the Mexican government of providing safe havens for those very cartels. Just how quickly is it escalating on that front?
Yeah, very. I mean, that was probably the thing that President Sheinbaum here responded to most forcefully over the weekend, was the idea that the government is somehow giving shelter to the cartels. She was defiant on that point, flatly denied it, and said that was an unfair assertion on the part of President Trump.
Creighton Harrison.
So that's the sort of thing that could really, sorry.
We're going to leave it there. Thank you, sir. Creighton Harrison from Mexico City alongside Tyler Kendall in Washington, D.C. and Divya Balji in Toronto. On that very subject, it feels like there's a lot of tension building there, and I just wonder, I don't really want to wonder too much, just what the next step might be on that front in Mexico.
Well, Pete Hegseth, I believe, said to Fox and Friends that everything pretty much is on the table, potentially even using the U.S. military. Trump has made very clear when it comes to Canada and Mexico, what he is so focused on is illegal immigration and the flow of fentanyl. And if you look at the data when it comes to fentanyl coming from Mexico specifically, we're talking about in 2024, more than 21,000 pounds of fentanyl coming across the border into the United States.
Joining us now to have the market conversation is Laurie Calvasina of RBC. Laurie, good morning to you.
Good morning.
Another interesting Monday morning, very different to the one from last week, but the market pointing in the same direction. You've heard this story a million times over the past 2 months or so, that the president is transactional, there will be scope for negotiation, he's regulated by the stock market. Has that changed?
So look, I think that there's still some of that in the price right now, right? And so the futures are down. They're not down a ton. And as I've looked across the commentary on the street that has come out since Friday, there still seems to be a lot of hope that there's still some window for negotiation, and that if these tariffs go on, it's going to be short-lived. And I find it interesting, sitting in my seat as a forecaster, I find the confidence that some of these things are low odds, low chances, when they're really more unknowable. I find that really interesting, and I think that's somewhat misleading to investors, to be honest. I think that personally, I think these things are more like 50-50, so they may not be baked directly into my outlook either, but I feel like the risks are much higher than people appreciate.
This is a difficult art, more than a science, but how much more could markets sell off if they took it seriously that these tariffs were here to stay?
So I think there are probably two phases. I think the first phase is what I call sort of a 5 to 10% garden variety pullback. That could be a pullback for any reason. We've had a whole bunch of those since 2022. And I think we're overdue for one of those right now, frankly. And if you look at where valuations are, where positioning has been, and where sentiment was on sentiment surveys late last year, it looks like we've had a setup for that, regardless of it's tariffs or something else. Now, if you go from 10% and you kind of break down more than that, typically you don't sort of stop before you get to 15. 15 to 20% is what I call a growth scare. So if we get to a point, right, where tariffs, are going to happen, the street's expectations are disappointed, they're going to go through, but we don't think that's really going to damage economic growth too much, maybe just hit profit margins, maybe just be painful, maybe just push us down to kind of a level of growth we don't love but isn't recessionary, that's a 5 to 10% drawdown. But if you start to really see investors question the economic growth impacts, that's when you could flip down into the 15 to 20% level. I'm not in that latter category yet, but that's how I think we could get to something worse.
The reason why a lot of people are not in that latter category is because if you look at all the commentary, people are saying the U.S. economy is strong enough and U.S. corporate balance sheets are strong enough to withstand the potential growth impact from any of these tariffs, even if they were to stick, based on the earnings that we've seen, based on what you're seeing in terms of the momentum. Do you agree?
So look, I do think the resiliency of the economy and the consumer in corporate America tends to get underestimated. And that's sort of a bug of this post-COVID environment. That's very much a learning that people took from the post-GFC world, when generally forecasters would start out as too optimistic and have to dial everything down. Now these days we start out as too pessimistic and dial everything up. That being said, if you look at company commentary on the tariffs, I do not think that they are prepared for the kind of tariff episode that we are about to start. If you look back in November, we got a lot of comments at conferences, especially from healthcare, consumer discretionary, industrials, materials, where they were talking about the lessons of the China trade war in 2018 and saying, don't worry, we got this. And oh, by the way, we reduced our China footprint. That's fine. But where did that China footprint go, right? It's gone to some of the places that are being targeted now. And so when we've seen the commentary in this reporting season, tariffs are still probably the dominant issue, especially on this policy discussion. But companies are saying more like, well, wait and see. Some companies are saying, well, we've got some teams working on this. But everybody's saying they're going to pass through the prices. And so I think there's a lot of thinking that's being done. I do think we have to give companies credit for managing through crises. Are they prepared for this one today? No. I don't think so. Can they get there? Yes, but it may take a little time to figure that out.
Trump has been saying this for months, though. So why the complacency?
It's really puzzling to me, Annmarie. It's just this idea, I think, of, and we did see this somewhat back in 2016, 2017, the idea, well, that's not good for the economy. This can't possibly happen. I think there are other motivating factors here. And I think with the tariffs in particular, what I've seen really is just this idea of, well, they can't possibly do that. It's just a negotiation tactic. They're not going to go through with it. This to me has seemed more like a core belief in terms of this being an appropriate policy tool. I think there's a conflation between economic policy and foreign policy that people don't quite appreciate. And we also have a president that's not up for re-election. So I think that's another thing we have to consider and maybe being missed by markets.
Laurie, you're dead on. It's so different this time. The objectives are different. It was about reciprocity with China. This is about the southern border. I would say the backdrop's very different as well. People make the argument on this programme repeatedly that the economy is more prone for inflation this time around. I think we've got to draw a distinction between, by definition, who pays the tariff, the importer. I think that's settled. Let's not waste any time on that. The debate has got to be about how the cost will be distributed. We know that exporters can drop prices. We know that it could be eaten across the supply chain through margins, or in some cases, depending on the product, might be passed on immediately to the consumer. How are you thinking about margins for corporate America now on the S&P 500?
So margin expectations for 2025, if you look at the Bloomberg data that monitors the bottom-up consensus, they've already been falling since last July. So they're still looking pretty healthy. I don't want to confuse anybody there, but they've been sort of slowly, quietly getting reined in. And even before this tariff issue, companies have already been, sort of, I wouldn't say they're raising the alarm bell, but they've been sort of quietly nudging the analyst community and reminding them about all the cost pressures that are already out there. So we're laying this on top. And again, they are making, the one commonality I see in these tariff discussions, we will pass the price along. Now, some companies are other companies' customers, right? So that's going to show up in their margins. But the other thing I've been intrigued by recently is if you look at the consumer sentiment surveys, we've had soft readings on both Michigan and the Conference Board recently. And it's not necessarily what everybody's talking about, but if you dig into those details, inflation expectations among consumers themselves have also been perking up. So that's a problem. The other stat I've been fascinated by is the NFIB Small Business Optimism Index, which has surged. Uncertainty levels have come down a little bit, but are still really, really high versus history. So, I think on Wall Street, we all assume that we all know these things and the average guy on the street isn't aware of them. I know I had a discussion with my in-laws on Saturday night about the tariffs. And one of my colleagues told me his daughter came home from school and she had 6 homework questions on tariffs. So I think the idea that this is not filtering into Main Street, I think we need to sort of check ourselves with that on Wall Street.
Are we knocking on the door of the limits of consumer price tolerance in this country after several years of above target inflation over at the Federal Reserve?
Mohamed El-Erian actually had one of the most salient things to say on this. He said a lot of companies have removed all of those stickers. Remember when they used to have stickers saying the retail price is $2.99, so buy this? They don't exist anymore. And why? Because they all are prepared for dynamic pricing in real time to pass it along.
Laurie, it's good to see you. As always, you're going to be sticking with us. Laurie Calvasina of RBC. Much more still to come on this market. Equity futures on the S&P at the moment, negative by 1.3%. The automakers down across the board. We'll get into that in just a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. It's the main story today. President Donald Trump following through on his promise to put tariffs on America's biggest trade partners. He announced 25% tariffs on Canada and Mexico and 10% on China, all set to go into effect just after midnight tonight. The president admitting American consumers may take a hit. Meanwhile, on the Fed, Trump said the FOMC was right to pause its rate cutting path last week. Speaking to reporters when he arrived in Washington last night, the president said, "I'm not surprised. Holding the rates at this point was the right thing to do." It marks a shift with Trump before the decision calling on the central bank to cut rates. And crews are set to begin lifting the American Airlines jet from the Potomac River today, this coming 5 days after the plane and an Army helicopter collided in a fiery crash that left no survivors. The Army Corps said the process could take 3 days to complete. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program, Trump's tariff confidence.
Tariffs don't cause inflation, they cause success. Cause big success. So we're going to have great success. There could be some temporary short-term disruption, and people will understand that.
The price of those tariffs maybe not as expensive as you might expect this morning. We're down, but not down too hard. We're negative by 1.4% on the S&P. From New York City this morning, good morning. Live from New York City. What a way to start a trading week. Equity futures down across the board. On the S&P, we're negative by 1.4. On the Nasdaq, by 1.6. On the Russell, the small caps down by more than 2%. Under surveillance this morning, Trump's tariff confidence.
Sir, are you concerned about the market reaction around tariffs?
No. Tariffs. The word tariff is a very misunderstood word. You've heard me say. I say it kiddingly, but it's one of the most beautiful words in the dictionary. Tariffs don't cause inflation, they cause success. Cause big success. So we're going to have great success. There could be some temporary short-term disruption, and people will understand that.
So here's the latest this morning. President Trump doubling down on his decision to impose tariffs on Mexico, Canada and China, indicating he's not too concerned about the market reaction. With that reaction, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Depends who pays the tariff and for how long. I've gone for GM in the first instance, down 6.5%. A $25,000 car. Chevrolet Montana, $25,000, 25% tariff, $6,250 extra as of today. And you can be pretty darn sure Mary Barra is not paying that. You and I probably will. Not my kind of truck. But to some context for you, the US imports 3.6 million cars, including pickup trucks. 22% of the total from south of the border. But the big company that really took the pain is VW. 43, this is a European company. They bring in their cars from Mexico, and that is where 43% comes from. This is Ford down 3.97%. Apple. So what happens to Apple? Do they get a carve-out from China? Do they get a carve-out in terms of any other exceptions? Right now, this is about operating margin. BI have run the numbers. About 200 basis points of operating margin are up on the consideration here. So there's lots of different ways to think about these tariffs, the potential for them. Do they get a carve-out from China? 16% of their sales come from China. Jonathan, good morning.
Manus, good morning. Thank you, sir. More from Manus Cranny later on this morning. Check out the automakers. Stellantis, Ford, GM, down across the board here. Laurie Calvasina is back with us. Laurie, let's start with the automakers. Are there certain sectors that will be on the edge of uninvestable for the next few months because of what's happening here?
Look, I think that this, my colleague Amy calls this the paddling duck market, right? Where we price in all these risks under the surface and you don't quite see it translate to the broader index. And I think that's what the market's doing right now. I don't know if I would quite use the word uninvestable. I might have said that about healthcare a few months ago, and it's actually been, doing pretty decently so far this year. So maybe just with heightened policy risk or just heightened risk for quite some time is how I would think about it.
Where is that risk? I mean, we were talking about the auto manufacturers, but I was looking at some of the retaliatory tariffs coming from the likes of Canada and Mexico. They are targeted. Things like whiskeys from Kentucky, oranges from Florida, appliances from South Carolina. What do these all have in common? They are all red states. They're also talking about a Harley-Davidson plant in Pennsylvania. How seriously do you have to take that?
I think you do have to take it seriously. And, we put in our piece this morning, we said, here are the things we're watching. And one of the things we're watching is the vibes. Those are corporate vibes and those are consumer vibes. And I think, again, going back to these sentiment surveys, we just haven't seen this big pop in excitement that we might necessarily have been led to believe we were going to see this year. And I think all of this does weigh. So I don't know if it's any one industry in particular, but I do think it's that vibes thesis that we have to be really careful about going forward.
Well, sticking on vibes, Trump is not just all sticks. He's also carrots. And I know a lot of market participants are very excited about the fact of tax cuts. How do you weigh both of these issues?
Well, look, there's just not a lot of information out there right now, right, on what this tax bill is going to look like. And, we kind of know some vague things from the campaign, right? No taxes on tips. We know that they want to extend the tax cuts. How much more exactly is coming? I'm not quite sure. I will tell you that, again, as I go through sort of the company commentary, I'm seeing a lot of excitement on regulation, things like M&A, again, going back to this anticipated uptick in the vibes. A lot of concern on tariffs. Very few companies are mentioning tax. So I think that's where there's really some opportunity if we can get some interesting news there.
Annmarie, I'm pleased you bring this up because I think it's really important. The tariff story is one piece of the overall policy platform. The rest of it is kind of complementary. This is what they're trying to do. And you can sit here and disagree with it. You can say it's the wrong thing to do. You can say it's going to have negative consequences. But ultimately, they've said everything they want to do. They want to put the walls up. They want to run things really hot domestically. And to achieve that, you tell people that if they want to sell in America, they've got to be in America. And to entice that, you've got to drop corporate taxes pretty aggressively. And he said repeatedly on the campaign trail, they would do that, come down to 15%. And alongside that, there would be a domestic production target. That if you want 15%, you've got to produce the goods here. So I think you've got to see a much fuller policy platform to really think about the economic consequences of what they're doing here.
Also about the consequences of these tariffs. Are they a negotiating tool or used as a national security concern, or are they going to be used as an offset and a revenue raiser for this package that they want to get through Congress? If they're a revenue raiser, they might be here to stay.
Then there's no scope for negotiation here whatsoever if this is to offset tax cuts later this year.
Well, and if that is actually something that could work, I am curious about whether the U.S. has the people to manufacture some of this. I'm curious about the labor market required to achieve the policy goals that you laid out. It might be there, and it might actually be something that people are pricing in and seeing this rearrangement as being a hiccup, but then leading to growth. This is one of the key questions.
It takes a long time to engineer the supply side of the economy. If you want to ignite that supply side response, it's going to take years, not months.
So what is the adjustment period, and how is this country going to ameliorate that at a time when the borders are increasingly closed?
Laurie, it's good to see you. Great to catch up. Big week ahead of us all, I think. Laurie Calvasina there of RBC. The conversation continues. We'll catch up with the former chair of the Council of Economic Advisors under President Obama. Jason Furman is just around the corner from New York with equity futures down by 1.4%. This is Bloomberg. Tobin Marcus, Wolf Research, put out a note over the weekend. Markets may now need to take the rest of Trump's tariff agenda literally, rather than just seriously. We're taking it literally this morning, kinda. Equity futures down across the board. We're down by 1.4% on the S&P, on the Nasdaq down by 1.6%. It's the small caps that take much of the pain. We're down by more than 2%. But check out the bond market. Spend some time on this. 2-year, 10-year, 30-year. So what makes the move? We recalibrate things at the front end of the curve. Yields are higher by 8 basis points. The why? Fed's not cutting interest rates anytime soon. If these stay on, maybe even has to consider hiking interest rates later this year if Adam Posen is to be believed. But at the long end of the curve, what do you do with a 10-year yield, Lisa? 4.54.
Honestly, how do we understand this? Number one, you could say this is just not a stock market that's selling off that significantly. So the risk-off move isn't that great. The bid into the long end isn't that great. That is sort of the cop-out way of not giving really any credence to this whatsoever. There is another way of reading this, which is that a lot of people do not see this as much of a growth hit to the U.S. economy as people expected, and that longer-term inflation could remain elevated. And you could see that in break-even rates, and that could be on the margins what's happening to the 10-year. We need a couple more weeks before we can start to say that with it.
I would say there's a tug-of-war taking place right now, and there's a lot of tension in the long end of the bond market. A tug-of-war between a demand shock and a supply shock that could lead to inflationary consequences. And I think we've got to figure out what the future might look like if, and it's a big if at the moment, if these stay on.
That's a much more diplomatic way of saying it, the tug of war. People just have no clue. It is, though, notable. The dollar is a haven. The bond market is not. And that is something that you have to take notice of because the moves are big enough in other places that you normally would get a bid into this particular security.
The dollar is getting bought big time. The dollar is stronger against the Mexican peso, as you might expect, against Canada. Europe. Can spend some time on Europe too. Europe's going to get it as well. This is what President Trump has said repeatedly. Europe doesn't need any more problems. Could have an extra one. Euro dollar down to 102.38, and I've just seen a string of analyst notes saying parity, parity, parity. And let's face it, parity is just around the corner.
Look, we're looking at the lowest levels going back for the euro to 2022. What would hold Donald Trump back? And right now, given the fact that you see that inflation came in higher than expected, what ammunition does ECB have to really combat this?
Under surveillance this morning, our top story worldwide. In this market, President Donald Trump ramping up tariff threats to the European Union, saying levies will, quote, definitely happen. So far, the president not specifying a level or a timeline for any actions against the European Union. For China, the Commerce Ministry reacting to Trump's tariffs, vowing, quote, corresponding countermeasures alongside a WTO lawsuit. China has a range of tools to respond to the levies, including export controls on critical minerals and market access restrictions to some American firms. So we're waiting to see what they do, also waiting to see what Mexico does as well. That's going to be a big one a little bit later today, possibly.
Yeah, Claudia Sheinbaum, the president of Mexico, coming out with Plan B and outlining it. That might be more salient than China, considering the fact they don't want to blow all their ammunition now when this is just ramping up.
Wanted to squeeze this story in. If we weren't talking about trade, we probably would have opened the program with this. Elon Musk saying his Doge team is shutting down some Treasury Department payments to federal contractors. The move suggesting Musk may have access to sensitive systems used at the Treasury. Musk posting on X, quote, the corruption and waste is being rooted out in real time.
So there's a lot of questions surrounding this, and even if Doge has authority to do this, of course, it is Congress that mandates about the money that gets spent. But in this tweet, he's talking about the fact that he has gained access to some of this. I would also say he also sketched out plans for aggressive cuts overnight to U.S. aid. And then he was also talking about assuaging some concerns of bond investors and saying that he and Jamie Dimon are going to be discussing that this week.
More on that story a little bit later. Let's get back to our top story. President Trump set to speak with leaders of Canada and Mexico today, ahead of tariffs going into effect tomorrow, as he ramps up threats against another key ally, the European Union. Jason Furman of the Harvard Kennedy School writing, it's hard to decide if tariffs are worse economic policy or foreign policy. We'll see if Trump caves to the market. Jason joins us now for more. Jason, welcome to the programme, sir. Thanks for making time for us. Let's just start here. How different these actions are compared to what we saw in Trump's first term.
Oh, yeah, look, I thought there were too many tariffs in Trump's first term. I thought they were too poorly designed, but this is just at a massive scale relative to those. And these are against close allies. And this is less than, this is basically 2 weeks in to the administration, and he's promised us he's just getting started.
Jason, it seems like on Wall Street, people believe that the U.S. economy is strong enough to withstand the growth hit from these tariffs. Do you agree?
First of all, it doesn't look to me like Wall Street has priced in these tariffs going into effect on a sustained basis. And by the way, I hope Wall Street's right about that. Some things are crazy enough that you touch the hot stove and you pull your hand away. And I think that's what Wall Street thinks would happen. So you can't look at the market right now to infer what would happen if over the next year we keep these tariffs on, escalate them in response to their responses, add tariffs to the European Union, add a universal tariff. All of that, I have no doubt, would be quite a big hit to growth.
Jason, as you know, though, of course, USMCA is up for renegotiation next year. How much are these tariffs a part of that carrot and stick approach for that renegotiation with Canada and Mexico?
USMCA was President Trump's trade agreement. And look, it's sort of ironic. In 2016, he campaigned on tearing up NAFTA, and he ended up doing a renegotiation of it that was pretty good and that got everyone on board. This time around, he actually did not campaign against NAFTA or USMCA, did not really campaign against Mexico and Canada, and he's straight out of the gate with tariffs on them. I don't really see this as part of a ploy to have a better USMCA negotiation. I don't quite know what we're looking for in a USMCA negotiation.
Well, he did campaign, though, on making sure that he put a halt to illegal immigration and stopping the fentanyl flow. If you look at our own drug enforcement data, 21,000 pounds was seized at the southern border of fentanyl, 43 pounds of fentanyl from Canada. 2 milligrams of fentanyl is lethal. There's more than 450 milligrams in a pound. If that is the direction that Trump is taking and it comes to national security, do you see this administration using tariffs, say prior administrations might use things like sanctions?
First of all, you just said the number for Canada was tiny compared to the number for Mexico. And by the way, fentanyl goes from the U.S. border to the Canadian border as well. Do you think they should be putting tariffs on us to stop that flow of fentanyl? Absolutely, we need to put pressure on Mexico, but it's not like they have a switch that they could choose whether or not to push. This has been a big issue for them. It's undermined a lot of their country, the drug trade as well. And by the way, destabilizing the Mexican economy is going to increase the amount of immigration to the United States, not reduce it.
Jason, there's a larger theory here that the U.S. needs to produce more of its goods at home, both for national security reasons and also to give jobs to people in areas that got beaten up during a lot of the globalization shifts that we saw in the economy. What do you think it would take to bring production back? Do you think that's a feasible goal? And how long would it take?
Yeah, I think what it would take to bring production back is to have an integrated market in North America where inputs for American manufacturers can come in tax-free, where auto parts can go back and forth across the border multiple times. That's the way you have an American auto industry. You don't make every single piece that goes into the car. You have, a lot of the value added, a lot of the key stages of the process, but you spread production out around the world. That's what makes the American economy so incredibly successful. Look at U.S. productivity growth compared to any other advanced economy. It's been much higher. Globalization has been a key part of that. This is going to destroy American manufacturing if it continues and escalates.
Jason, couldn't you make the argument that globalization destroyed American manufacturing?
Productivity growth has been the biggest factor in reducing American manufacturing. Manufacturing jobs have fallen in China. They've fallen in Germany. They've fallen in the United States because you can make things with fewer people. And by the way, even if you want more manufacturing jobs, you don't raise input prices for manufacturing. You don't strengthen the dollar to hurt exporters. You don't weaken the economies of our trading partners. You don't encourage them to put tariffs on manufacturing. Every single aspect of this is bad for American manufacturing.
Jason, just a final word in the 1 minute we have left with you, just on prices. By definition, the importer pays the tariff, so let's just put that all to one side. What's your base case on how the costs will be distributed? How do you see this playing out? Will it all get passed through to the consumer? Will it be eaten elsewhere?
There'll be a little bit of it eaten by the Canadians and Mexicans in terms of the appreciation of the dollar. Some of it eaten by margins. So I see something like an extra 0.5 point on inflation. And if you go from 2.5 to 3% inflation, that's a big difference for the Fed.
Big change. Jason, appreciate your input and your insight. Thank you, sir. Jason Furman there at the Harvard Kennedy School. Seen that estimate repeatedly. I think I saw the same thing from Goldman and Morgan Stanley. Big if, of course, if it stays on, it could push inflation up by something like 0.5 percentage point. And for the Federal Reserve, right now in a sticky spot and not signaling they're going to cut anytime soon, that's a significant adjustment for them.
Which is the reason why you're seeing a bigger move at the front end of the yield curve, why 2-year yield is actually increasing more than a 10-year yield. That's the cleanest read-through in the short term.
Got to spend some time on energy, haven't we?
Yes.
4 million barrels of oil a day comes from Canada into North America, into the United States, and the bulk of that gets refined in the Midwest. This is going to cause some problems for that region of this country.
And there's some refiners in the Midwest that only take Canadian crude. And it was implicit in the acts that Trump did that he understood this effect because he didn't do 25% across the board for Canadian crude along with the other goods Canada exports into the United States. He brought that down to 10%. You see the market reaction already this morning with U.S. gasoline futures higher. If this starts to hit consumers at the pump, he might have to rethink this.
I think it was the Conservative leader, Poilievre, that made the point. And I think it's a really interesting point. And I haven't heard this question asked enough over the weekend or this morning either. Why the tariff was lower for China than it was for the North American neighbours, Canada and Mexico. How do you explain that?
It's a great question. First of all, someone could say it's on top of the 25% tariffs that he previously had implemented. Second of all, he closed a huge loophole. And this has not been talked about enough, where basically packages under a certain amount were exempt from those tariffs. Now your Shein packages and your Temu packages will not be exempt from some of these tariffs. That change would be enough to exert a significant hit to certain Chinese manufacturers.
The de minimis loophole is huge. This means any package under $800 is no longer exempt. This loophole is closed. It's going to hit China e-commerce. And again, once again, this is coming from a Trump administration clearly looking at fentanyl, because there's been a lot of reports that have been done that is how fentanyl is smuggled into this country.
So your $4 T-shirt goes up $1. Is that right?
That's what I hear from home people.
We'll see if they've got the margins to eat it. I'm not sure those companies do. Equity futures right now on the S&P negative by 1.5%. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Trump's tariffs against Canada and Mexico are threatening automakers across North America. The duties would immediately hit almost a quarter of the 16 million vehicles sold in the U.S. each year. And Wolf Research analysts are estimating it could raise the average price of a new car by about $3,000. Meanwhile, Panama is promising free passage for U.S. warships through the Panama Canal. This comes after Secretary of State Marco Rubio blasted the government during his visit yesterday. Panama President Jose Raul Mulino also said they will withdraw from China's signature lending program. Still, he reiterated his country won't give up the canal. And Elon Musk, who's running the government efficiency initiative DOGE, is planning aggressive cuts to U.S. spending, including wiping out the U.S. Agency for International Development. Musk claims to have President Trump's blessing to end U.S. aid as a standalone agency and fold what's left of it into the State Department. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Trump's tariffs hit oil.
Mexico and Canada have never been good to us on trade. They treated us very unfairly on trade. We don't need the products that they have. We have all the oil you need.
The latest on the energy market up next on a program live from New York City. You're watching Bloomberg TV. Stocks are down across the board here. We're negative by 1.5% on the S&P 500. We're down by 1.7 on the Nasdaq 100, on the small caps down by more than 2. The stocks to watch, there are many, but I think you've just got to keep one eye on the automakers throughout the session. GM, Ford, Stellantis. GM had such a painful week last week, even though, Lisa, they came out with decent numbers and a half-decent outlook. And the worry was that outlook didn't count for much because we're about to get tariffs, and we got some.
And they actually rely so much more on Mexico. They have moved a lot of their supply chain to the north of Mexico, away from China, away from other areas that were hotspots, which is the reason why they're now getting penalized by 25% tariffs on Mexico.
That's the automakers. We need to talk about energy as well. Under surveillance this morning, Trump's tariffs strike oil.
Mexico and Canada have never been good to us on trade. They treated us very unfairly on trade. And we will be able to make that up very quickly because we don't need the products that they have. We have all the oil you need. We have all the trees you need, meaning the lumber.
Do we have the kind of oil we need? Here's the latest. Oil prices jumping as President Donald Trump places tariffs of 10% on energy from Canada. The measure affecting 4 million barrels of crude from the northern border. Bloomberg's Michael McKee has more. Morning, Mike.
Good morning, John. You put your finger on the big problem. We have a lot of oil, but we don't have the kind of oil you need in parts of the country, particularly the Midwest. It's heavy crude that comes down from Canada, and PADD 2, the Midwestern area refineries, there's about 23% of U.S. refiners in that area. They use that heavy crude, and it's not easily substituted. Patrick DeHaan of Gas Buddy says that could add 5 to 20 cents a gallon in those regions. And he also adds that there's been a jump in oil prices in the last week or so that hasn't been reflected in the Midwest. And they're likely to see a very large non-tariff related jump over the next week or so. So there's going to be some pain in the Midwest, definitely. Now, there's also a wild card out there, and that is New England. New England gets a lot of power from Canada, New York as well. The grid operators buy power on a daily and hourly market, and this is electricity. It goes through wires. How do you measure it? There's a question of whether it can be tariffed or not. But there's also natural gas, and there's also oil that comes in from Canada, and companies are already saying they're going to raise prices. Irving Oil says they're going to pass the entire cost of the tariff on to its customers in New England. The Massachusetts governor forecasting as much as $200 million damage to the state's economy from all of this. So energy is a big, big issue, and it's something that's going to play out very quickly in the economy.
Mike McKee, thank you, sir. More from Mike a little bit later on this morning. Amrita Sen of Energy Aspects joins us now to extend the conversation. Amrita, what does a 10% tariff on 4 million barrels of crude a day do to this energy market?
I think, look, the 10% tariff in itself doesn't break U.S. refining, but for sure it adds to the cost. U.S. refining margins are not great to begin with. We've calculated even if Canadian heavies take 70% off the tariff, you still lose about $1 from Midwest margins. I think the critical thing also is to watch for is the Canadian dollar. That's weakened a lot. So that also helps absorb some of the tariffs. But ultimately, yes, you are going to get a hit on U.S. Midwest margins, also U.S. West Coast margins. We're going to see more of the Canadian flow on the TMX pipeline to Asia instead. And U.S. will have to pay up for alternatives. If I may say, I think more than the Canadian one, it's the 25% on Mexico. That's going to be the much bigger problem, given the Gulf Coast imports about 400,000 barrels per day of Mexican heavies, and another 200,000 of feedstock, what we would call fuel oil. That's going to be very hard for them to replace, and it's a higher tariff as well, given it's 25%.
Amrita, you mentioned something in there that I want to pick up on, exporting more to Asia. How easy is it for Canada and Mexico to shift its export lines to direct more of it to China in the Southeast Asian Sea rather than the United States?
Well, because Canada now has the TMX pipeline. In the past, they wouldn't have been able to do so, would have been a lot harder. But now with TMX, it actually gives them a lot more optionality. And if I may say so, I think these tariffs have essentially handed a boon to Asian refiners. And it's obviously bullish for PADD 1 margins because PADD 1 is losing product exports from Canada, but it's also boosting European refining margins. It's a win for a lot of the rest of the world, just a massive loss for US refining, which given that it's meant to be America first, I'm not 100% sure that was the intended consequence, but that's absolutely how this is going to play out.
How long before the United States could produce the kind of crude that would be good for refining? How long before the U.S. can compensate and offset that with the energy that Donald Trump was talking about?
They can't. I mean, the reserves are light shale. It's a geology problem. We can, scream and shout as much as we want about the volume of oil produced, but every refiner on the Gulf Coast and a lot of them in the Midwest are complex refiners. They need the heavier crude. And that's why they were designed, because they had availability of Canadian and Mexican heavies. Gulf of Mexico produces some medium sour crudes, but it's not the heavy material that these refiners need. So it's a geology problem. It's nothing to do with, regulation or anything else. U.S., of course, has all the oil the refiners require. It's just the wrong type of oil.
So, Amrita, where can they import this type of crude if it's not going to be from Mexico or Canada?
So I think the Canadian imports will still continue because, again, like I said, the 10% tariff, again, we'll get it split between refiners and Canada, but I think those will continue. I think the challenge is going to be on the Gulf Coast. We do see more Middle Eastern barrels arriving, potentially from Iraq, even some Saudi Arabia, and other Latin American countries can swing. But it's going to be a tough ask. And by the way, we don't even know if Mexico is going to retaliate. If it does on oil products, which is not our base case, but U.S. Gulf Coast refiners send 850,000 barrels per day of products to Mexico. They will not find a home and they will have to cut runs. That's the one to watch out for.
Amrita, with an uptick in prices right now, we also have OPEC Plus members meeting today. Is this a moment for them to want to add barrels to the market?
Today is a JMMC meeting rather than an OPEC ministerial meeting. The JMMC simply, just takes stock of where fundamentals are. We've maintained our view that they will absolutely have to see outright supply disruption, not just trade flow shifts, which is what's happening right now, before they change course. So we maintain the view that, the earliest you're going to start seeing OPEC Plus unwind is April.
Amrita, appreciate your time. As always, Amrita Sen there of Energy Aspects. If you are just joining us, welcome to the programme. Crude up across the board on both WTI and Brent. WTI up by 2.7%, Brent crude up by 1.7%, Annmarie at about $77 a barrel.
This is going to be a big deal when it comes to those landlocked Midwest states, these refiners that rely on the heavy crude coming from Canada. Now, Canada, implicit in Trump's 10%, he realized how important that is. Amrita makes a great point. Nearly 500,000 is coming from Mexico, and they're getting the 25% tariff hit. Where do these refiners go? Amrita Sen is talking about maybe as far as Iraq. Can't really go to Venezuela. There's sanctions there. Maybe Brazil. They're going to have to get creative when it comes to these trade routes if they want that heavy sour crude.
The pass-through can be pretty immediate in some cases, depending on what goods you tariff, and this might be one of those where it's pretty fast.
Which is the reason why it was just a 10% tariff rather than the full 25% on Canada. Key question will be, will Canada turn to these exports to the United States and have retaliatory tariffs in a significant way? That would be the nuclear option, certainly, that Trudeau has not pulled out of the hat yet.
You know who I want to hear from? I want to hear from the NEC Director, Kevin Hassett. I want to hear from the Treasury Secretary, Scott Bessent. But who I really want to hear from? Governor Waller at the Federal Reserve, who believes that these tariffs won't be inflationary, won't change the course of monetary policy for the Federal Reserve. I'd love to know if he still thinks the same thing after what we heard over the weekend, if, of course, these stick.
Well, I don't see him speaking today, so you're going to have to just wait. My guess is he would say it's too early to say. And a lot of people are saying that it's sort of equal measures growth hit as inflationary hit, which is what the 10-year is saying, that tug of war. And he might defer into that. But I did think it was interesting that Trump said they made the right decision. So maybe he's on board with everything.
I still think there's a bias in this market that all of this gets negotiated away.
100%.
It's a 1.5% move on the S&P. Stay tuned. Up next on the programme, Jay Pelosky of TPW Advisory, the former NEC Deputy Director Kellyanne Shaw, the former St. Louis Fed President Jim Bullard. That and a whole lot more from New York City, the second hour of Bloomberg Surveillance. Up next.
This is frankly nuts. Canada and Mexico are our two largest trading partners.
The signals he's sending suggest that he sees values in tariffs above and beyond even their negotiating leverage.
There are near-term inflation effects when you're implementing tariffs.
It could change on a dime, but I think once they're on, then it's harder to take them off.
We think that this could actually be highly disruptive to supply chains, potentially inflationary because of that disruption. This could weigh on growth and inflation in a more meaningful way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Here are the scores. Equities down across the board. We're negative 1.4% on the S&P. Make it 1.5 on the Nasdaq. We're down as well. Likewise on a Russell. The Nasdaq 100 this morning negative by 1.7%. The small caps down by more than 2. You want some single names? Let's pick out 3. The automakers, Ford, Stellantis, GM trading a whole lot lower. General Motors having a terrible week last week. A 4-day losing streak. Make it day 5. GM's down by more than 7%. The winner of all of this, the US dollar. Its best day since the day after the election. Even euro is getting in on the act. Euro dollar negative by more than 1 full percentage point. 102.52, the lowest level we've seen going back to 2022. And here's the big take, and I think it's important to say this. For a lot of people in this market, they still believe this will be negotiated away. Goldman Sachs, Jan Hatzius and the team over the weekend. While the outlook is unclear, these tariffs are likely to be short-lived.
Basically, this is not a market that is actually pricing in these tariffs. They are pricing in the idea of tariffs. They didn't believe that they would actually go into effect on February 1st. They did. Now they don't believe that they're going to stick. There was a theory heading into 2025 that the market would act as a check on Donald Trump. Right now, if that is the case, the stock market isn't reacting with enough of a tantrum to be that check. And there's a real question about whether that put really is still there.
So the fireworks might actually happen tomorrow if the tariffs stay in place. Trump said last night, this morning, he's getting on a call with the leader of Canada, the leader of Mexico. So there is potentially the market baking in this hope that they can walk this back, like we saw him do when it came to Colombia. But if not, how much lower will we see on these markets come tomorrow morning? Because we are talking about broad-based tariffs, 25% from Canada, 25% from Mexico. What I have been hearing is that he is in negotiating mode when it comes to these two countries. Less so when it comes to China, but they only got 10%.
We've repeated this repeatedly through this morning again. The president, for so many of you, is pro-growth. You'll see deregulation, regulated by the stock market, wants good things for investors. Do you question that this morning after the weekend?
Absolutely. And you're seeing that pretty much across the board. Neil Dutta basically came out and said, this just shows that the Trump put isn't as big as people had thought. And if this is as much of the market freaks out, well, is it really checking any of these policies or basically saying that it's not that big of a hit to growth?
Lori Calvasina made a good point, though. This is a president who came in with a mandate on immigration, and he's not running for re-election again. This is his last final 4 years and also a lot to get done before the midterms, potentially. So maybe they do stick because he has been talking about immigration and fentanyl for months, and that's what he's talking about when it comes to these sanctions and national security concern.
Equity futures on the S&P negative by 1.5%. Let's begin with our top story. President Donald Trump slapping 25% tariffs on Canada and Mexico and 10% on China.
We may have short-term some little pain, and people understand that. But long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country. Not every country, but almost. And we're going to change it. It's been unfair. That's why we owe $36 trillion. We have deficits with everybody. We help everybody. We've been helping everybody for years. And to be honest, I don't think they appreciate it. So we're going to change that.
So for many of you, the trade war begins right now. Canada planning a 25% levy against $106 billion of American goods. Mexico preparing a response, and China's Commerce Ministry vowing, quote, corresponding countermeasures. The tariffs set to go into effect in fewer than 24 hours. Your team coverage continues. Joining us now is Bloomberg's Tyler Kendall in Washington, Derek Decloet in Toronto, and Creighton Harrison in Mexico City. Tyler, I want to go straight to you. We talked about the calls that will take place between the U.S. leader and his Mexican and Canadian counterparts. One, we want to understand if there's scope for negotiation here, but also for the companies affected by this, will there be any carve-outs?
Right, John, these are still some of the questions that remain to be seen. We're waiting for what that benchmark of success is that President Trump needs to see when it comes to progress to to address immigration over the border and also fentanyl that is coming in. Now, the White House did circulate to us reporters here a memo touting some of their potential benefits when it comes to tariffs and downplaying inflationary concerns after President Trump suggested that Americans could feel a little bit of pain. Notably, the White House seems to be trying to hone in on this idea that these tariffs will help boost U.S. manufacturing, something that President Trump campaigned heavily on. But not everybody agrees, John. The National Association of Manufacturers, which represents about 14,000 U.S. businesses, in a statement obtained by Bloomberg News, said that this would have, quote, severe ripple effects for its members.
Creighton, when it comes to Mexico, Claudia Sheinbaum's talking about her Plan B. She's telling her economy ministry that she wants to enact the Plan B in terms of retaliation. What does that involve?
Well, I wish I could tell you a straight answer. They've been behind closed doors for most of the weekend. It's a long weekend here in Mexico. Today's a federal holiday. But we know that it's some mix of retaliatory tariffs and what she has referred to as non-tariff actions. We think that may be sort of gestures toward cooperation on security and closing the border. But we should hear more details in the coming hours as Claudia Sheinbaum rolls out her plan and her finance minister meets with investors.
Meanwhile, Derek, we have seen some response in terms of retaliatory tariffs coming from Canada, in particularly some goods from red-leaning states. What do we know about that, and what potentially could be to follow should the tariffs go into effect and stay there for a while?
Yeah, I mean, there's two phases to the Canadian response. One is on Tuesday, there will be tariffs on about $30 billion worth of goods, a lot of consumer goods, as you say, things from red states, orange juice from Florida and so on. But then there's a second phase, a much larger phase, that is Canadian $125 billion. That includes the really big ticket items like cars and steel and aluminum. But there's a 3-week process for Canada between now and when those tariffs would come on. And that is both to allow companies some time to adjust, but also perhaps gives time for a bit of an off-ramp if there are to be negotiations. I think in Ottawa, that is very clear what those negotiations, very unclear what those negotiations would look like at this point.
What could Canada offer as a potential off-ramp? Justin Trudeau will get on the phone this morning with President Trump.
It's a good question, and I think you can summarize that Trudeau and his cabinet are somewhat frustrated because the evidence on fentanyl and illegal migration coming from Canada into the U.S. is fairly thin, to be honest. There is some, of course. There's drugs that move both ways across the border. There are guns and so on. It's not that there are no issues at the border, but they are seen as relatively minor, and they have offered a security package, quite a visible security package, to sort of beef up some of the weak spots in the border, particularly around Quebec and New York State. So I think that there's a bit of frustration that they don't know what they can offer at this point.
You can sense that frustration. Derek, appreciate your time alongside Creighton and Tyler there. This note just dropped from Torsten Slock over at Apollo. Goods imports make up 11% of US GDP. 43% of imports come from Canada, Mexico and China. Torsten goes on to say this means that 5% of US GDP is directly impacted by these higher tariffs. This is meaningful when annual GDP growth is normally around 2%. It can make a big difference.
It could make a big difference. It makes an even bigger difference, though, for Canada and Mexico, where about 80% of their exports they send to the United States. And I keep going back to what George Saravelis of Deutsche Bank wrote, which is for Canada and Mexico, we see this trade shock, if sustained, as being far larger in economic magnitude than that of Brexit on the UK, and would expect both countries to enter a recession in coming weeks.
Hearing the same thing across the board. The likes of Mexico, Canada plunging into recession, and also this from Capital Economics too. The door just slammed shut on a rate cut anytime soon from the Federal Reserve.
You're seeing that priced into short end of the yield curve. What this does long term, no one has a clue. And you could see that from stasis at the long end. That said, there wasn't really pressure for them to cut rates. And Donald Trump doesn't seem to be pressuring this Federal Reserve to cut rates anytime soon, saying they made the right call.
I noticed that yesterday evening. That was probably the most surprising thing we heard from the weekend. The fact that the president thinks the Federal Reserve made the right call last week.
I was shocked, and it shows that he actually cares about inflation. And he wants to tamp down long-term inflationary expectations, make the University of Michigan sentiment survey great again.
Yeah, OK. We'll leave that one there. For those of you just tuning in, maybe not familiar with Bramo's sarcasm, very sarcastic. Jay Pelosky of TPW Advisory joins us now for more. Jay, good morning.
Tough to match that sarcasm, but it's impressive. 7 a.m. Impressive.
It's a big change over the weekend. The day after the election, and we caught up with you, we were pricing in a positive growth shock, positive demand shock off all these things we'd see from the incoming administration. Are we now pricing in a negative supply shock? And how different is that?
Well, John, I think, first of all, there's no surprise here, right? Everyone knows that President Trump is going to put tariffs on. So we are adopting at TPW Advisory what we call the Stoic strategy, right? Back to the ancient Greeks, imagine all scenarios, be surprised by none. And so we do not pay attention to what President Trump says. He says anything at any time. We want to pay attention to how he acts. What are the actions? And so, we don't often find ourselves in agreement with the Wall Street Journal op-ed page, but their title, The Dumbest Trade War in History, I think really applies here. But there are three keys as we see it. First, we think these tariffs are going to stick. Okay? Trump needs money. This is a money grab, period, to fund the tax cuts. These are going to stick, but there's going to be a furor around them, right? As you just pointed out. Growth down, inflation up. So this is probably it for tariffs. Not going to have any more bigger ones, additional ones, in my view. And secondly, China now knows what's going to happen, so it can act, right? We're focused very much on a global growth long cycle where stimulus from Europe and Asia extends and broadens out the global growth cycle, which supports global equities. And so we want to pay attention not to the news, but to the reaction to the news. And this reaction is muted. And there's a reason for that, because it's not a surprise. And therefore, what we care about are earnings. And what I think this does is this does reduce the growth shock, the upside to earnings. We have no room for multiple expansion. The U.S. is priced for exceptionalism, needs to have earnings growth. So we have been of the view single-digit S&P returns this year, double-digit non-U.S. returns. And I would just say that year-to-date through January, non-U.S. is outperforming the U.S., led by Europe and China.
So this is the key point. How does that continue if right now the rest of the world is treating, and investors are treating, tariffs put on by the United States as a much bigger growth shock for the rest of the world than the United States?
Because I think that's wrong. That's just going to be wrong. And the reason, again, is simple. Because the rest of the world has the ability to act. Who has fiscal space in the global economy, right? Germany's debt to GDP, 63%. China's debt to GDP, 65%. U.S. debt to GDP, 120%. We have no room. And the other thing where we disagree strongly with the consensus is the view that this is dollar positive. We think this is setting up for potentially the big fear that we have is a crack in the dollar, right? The U.S. is putting gates up and barriers up and breaking deals with the rest of the world at a time when there is no country more exposed to international capital flows reversing themselves than the U.S. The U.S. has never had more foreign money invested in treasuries, corporate credit, U.S. equities. If that money starts to go elsewhere, so we think capital repatriation is going to be a big term over the course of this year. Money is going to go back to fund Japan's stimulus, go back to fund China's stimulus, go back to fund Europe's growth. And that means dollar down. And that means if it starts to get going, that's big action.
If dollar's down, then what wins? Gold?
What wins? Commodities, right? And so what just broke out over the last month? Commodities. Commodities are the best performing asset class year to date, outperforming equities, outperforming bonds. Emerging markets, China. Okay, for all the negativity on China, and we've talked about this for over a year or more, and we've been constructive, bullish, and exposed, and China is outperforming the U.S. in equities. For all the negativity, and look, DeepSeek was a week ago, right? I mean, stuff comes fast. It was a week ago, DeepSeek. China tech is completely underowned. There is a massive rotation trade out of U.S. tech into China tech. China tech is world class, yet sells at a 50 to 75% discount to the U.S.
Because the state might take it over at any minute.
what might happen here?
And more export
I mean,
controls
come
might
on.
come down on China.
What happened to GM today? What did the state just do to GM, right? Just knock the heck out of it. I mean, it's not really any different, in
You
my
think
view.
these tariffs hold?
I'm sorry?
You think these tariffs hold? You think these tariffs hold? They stick?
Yes, yeah. I mean, it's a money grab. Trump needs money for tax cuts. It's that simple.
You don't think
that's why it's coming now?
They can't negotiate it on a call a little bit later this morning.
You know, if they do, big deal. Then that means that the tax cuts don't happen, and that's probably not all that negative, right? Because that means that inflation and rates probably are not that bad, and therefore the economy is okay, and earnings are okay. What Trump's trying to do is thread a needle, right?
Jay, you said that you look at what Trump does, not what he says.
Yes.
What he did, at least what we've seen in this iteration of his administration, is he threatened tariffs when it came to Colombia, but then he didn't use them because Colombia ended up taking the deportation flights out of the United States. Isn't there a chance for an 11th hour deal here?
Oh, yeah, sure. But in which case, status quo ante, big deal. Our view is we want to be in the non-U.S. equity markets. We think we're at the beginning of a multi-year move out of the U.S. into non-U.S. Commodities breaking out supports the idea of global growth upcycle, and expanding. And what we want to see now is non-U.S. equity breaking out to support the idea that that's where the action is going to be. And they're all right there.
Yep.
They're all right there. Europe, China, emerging markets, all at important technical levels. If they break up, and probably not today, given the action, but going forward, they break up and out, then the money that's going to follow that is going to be tremendous because absolutely nobody is invested.
Jay, you're going to stick with us. I'm pleased to say Jay Pelosky there of TPW. Equity futures down by 1.6% with an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Donald Trump says he will have separate calls regarding tariffs today with Canadian Prime Minister Justin Trudeau as well as Mexican President Claudia Sheinbaum. Trudeau has already pledged 25% retaliatory tariffs on more than $100 billion worth of U.S. goods. He says Trump's actions risks job losses and higher prices for Americans. A U.S. citizen was one of the 3 hostages released by Hamas over the weekend. The release was part of a 4th hostage prisoner swap, with Israel releasing 183 Palestinian prisoners in exchange. Israeli Prime Minister Benjamin Netanyahu is meeting with President Trump tomorrow at the White House. And DeepSeek, which you just were talking about, is the most downloaded mobile app globally, with India accounting for the biggest percentage of new users. That's according to app figures. Still, its total users pale in comparison to ChatGPT, and there may be more hurdles for growth as companies and governments weigh risks associated with the Chinese AI app. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the risks of Trump's tariffs.
If over the next year we keep these tariffs on, escalate them in response to their responses, add tariffs to the European Union, add a universal tariff, all of that, I have no doubt would be quite a big hit to growth.
That's the debate so far this morning. Equity futures negative across the board. From New York City, you're watching Bloomberg TV. Equities are down across the board here. We're negative 1.6% on the S&P. On the Nasdaq, we're down by 1.8 on the Russell. We're down by 2 percentage points. Europe, of course, not spared. The Euro Stoxx 50 so far in the session is down about 1.7%. Under surveillance this morning, the risk of Trump's tariffs.
It doesn't look to me like Wall Street has priced in these tariffs going into effect on a sustained basis. And by the way, I hope Wall Street's right about that. So you can't look at the market right now to infer what would happen if over the next year we keep these tariffs on, escalate them in response to their responses, add tariffs to the European Union, add a universal tariff. All of that, I have no doubt would be quite a big hit to growth. This is basically 2 weeks in to the administration, and he's promised us he's just getting started.
Will it stick? Is there scope to negotiate the tariffs going into effect in fewer than 24 hours? Back with us is Jay Pelosky of TPW Advisory. Jay, I want to go straight to a core call for you. and it's foreign exchange. Let's bring up the foreign exchange mood board this morning, if we can call it that. It's a bad mood. If you look across the board, it's dollar strength against the Canadian loonie, against the Mexican peso, and against the euro. Euro dollar down to 102.60. I just want you to briefly explain why you believe this might be this morning's move, but over the short to medium term, you're going to see a change potentially develop, Jay. Where does that change come from?
Well, I think, first of all, John, the U.S. is priced for exceptionalism, right? Everyone is here. The U.S. has outperformed the rest of the world for 15 years. That has brought in all the money, right? And what has made the U.S. exceptional is tech. And what just happened last week? U.S. tech was exposed by China as being not that exceptional. And that's just an inkling of what we think will happen policy-wise as we go forward. Here in the U.S., what do we have? We have policy chaos. I mean, as we were talking about this morning, Trump is trying to thread the needle between raising tariffs without raising inflation, lowering growth, or affecting the stock market. Not sure he's going to be successful. Outside the U.S., as we touched on earlier, who has the fiscal space to stimulate, to grow their economies? Germany and China. We expect both to stimulate. Germany after the elections, they'll ease the debt brake. China with its NPC meeting in the spring. Now they know what Trump is going to do. That's the advantage here. Trump has moved because he has to get going on the tax bill, because he has to extend the tax cuts by the end of the year. Now China can act knowing what the president is going to do. And sorry, just to finish, and then money follows that action. Sorry, you know I love this.
No, I love it, Jay. Never change.
It's the last slide
exactly.
of the PowerPoint.
I know. All right, come on, discuss the slide.
Conclude.
You done? You good?
Yes, I'm good.
All right, so here's my question. Ultimately, if you end up with this type of scenario, how much conviction do you have to have very little to no exposure with U.S. dollar assets, U.S. government bonds, U.S. equities, and just go into Germany and China right now?
Sure. Well, let's be straightforward, right? We run a global multi-asset model. We're 50% ACWI, 40% Barclays Ag, 10% Goldman Sachs commodities. We are overweight. We're 70% equities, 10% fixed income. We have had zero treasury exposure for over 2 years, and we are double weighted in commodities. What's outperforming year to date? What's leading? Commodities. They are breaking out. We think we're at the beginning of that. Just look at what Trump's tariffs are doing to oil. We are triple, quadruple weighted emerging markets with a double to triple weight in China. We think EM is going to lead non-US because a weak dollar supports emerging markets, a weak dollar supports commodities, and we are expecting money to follow the action. And where's the action? The best performing markets year to date are Europe and China. I mean, as much as people want to say China's horrible and Europe can't do anything, the market is telling us different. And we want to pay attention to the market. We believe the market is smarter than me, than us, than everybody. And so when we look at that, we see markets breaking out. We want to follow that action. And the fact that no one is invested in these spaces, China is uninvestable, is the opportunity. And as that money repatriates, capital repatriation, John, we're reshoring jobs. We're reshoring production. Why should we not reshore capital? And right now, the U.S. is telling everybody, you know, we don't really care about your capital. Basically, they're saying we don't really care. We're just doing what we need to do for ourselves. That is the message. And if the world's capital decides, well, then, hey, we got to do what's best for us. And what's best for us is going back home because we're finally getting our act together. Boom, the dollar starts to roll over, and there is a lot of room for the dollar to fall because it is massively over-owned.
This is a contrarian call. You'll be back in a month and we'll check the scores.
Excellent.
All right,
Happy
Pelosky of TPW Advisory with a very different view on financial markets.
Yeah, Germany and Europe has a lot of investment to do. I was in Austria. They ran out of a train. I had to take a bus.
This feels personal.
It's true.
Are you really going after infrastructure?
No. Okay, all right. But the train system of Germany and Austria.
Bramo's train's delayed. Now the Euro Sox 50. Is that how this works? That's not trading advice, okay? From New York, this is Bloomberg. So two views. Here's the less constructive view. Nil data, Renmac. The strike price on the fabled Trump put might be much lower than investors appreciate. Here's the more constructive view. Picariello Academy. Stopping the flow of fentanyl. This rationale for imposing tariffs may be the reason why these tariffs are short-lived, and have minimal impact. Which one you choose is the judgment call this morning. How long this lasts? That's the key question. Equity futures down across the board. On the S&P 500, we're negative by 1.6%. The underperformance from the small caps, the Russell, down by more than 2 percentage points. With your movers this morning, it's Manus Cranny. Morning, Manus.
Jonathan, good morning. And it is all about relativity. For GM, 63% of their cars are assembled here. Their cars and their flatbeds are assembled here in the United States of America. Ford is 83%. So it's about the relative exposure to these tariffs. A $25,000 truck by Chevrolet is not going to cost $6,350 more, $250 more than it did at the close of business tonight. This is about the scale of import. The US imports 3.6 million autos from Canada and Mexico. 22% of the total amount sold here in the United States last year. Worst case scenario, RBC, Tom Narayan has done the numbers. You could have a double-digit hit on earnings, down 21% for GM. The biggest bruiser of them all is actually a European company. It is Volkswagen. They export 500,000 autos from Mexico into the United States of America. German auto suppliers operate 330 sites in Mexico. This is about a deficit which is vicariously transferred from Europe into Mexico to the United States of America. It's about triangulation. Constellation brands, Modelo, Corona. You fancy a beer? It's possibly going to get a little bit more expensive. Constellation Brands, of course, imports these Mexican beers into the United States of America. What's the margin hit? Piper Sandler downgraded the stock to neutral from overweight and a PT drop to $200. Again, we're still a little bit away from that, from $245. As you said, Jonathan, it's about whether you take the bid of the offer, short-term margin, or is it something much longer term with a harder to define off-ramp?
Manus, thank you, sir. Constellation Brands down by close to 7% in the pre-market. Under surveillance this morning, our top story. President Donald Trump saying he will speak with the Canadian Prime Minister Justin Trudeau and the Mexican President Claudia Sheinbaum later on today. Sheinbaum is expected to deliver new measures against Trump's tariffs at 8:30 Eastern Time. This is what we all want to know. What can they do in the next 24 hours to stop this from happening?
Well, we don't know yet because Trump talking about it has not really given an off-ramp. We don't know what would constitute a success from either Canada or Mexico for him to pull back these tariffs that will take place after midnight in less than 24 hours. What's interesting is the timing of this. She's set to speak at 8:30. Does the phone call between Sheinbaum and Trump happen before or after that? She talked about this plan B, but we don't know yet what the plan B entails. If you look back what happened Trump 1.0, when it came to aluminum coming in from the United States, coming to the United States from Mexico, they went after things like pork and other measures from red states, as Lisa's been talking about, that Canada is doing as well.
You mentioned the timing. It's a few days before the Super Bowl.
So avocados,
people are calling this the Super Bowl tax because you have your cerveza and you have your guacamole, and guess what? It's going to be a couple bucks more, and that's basically on the talk shows what all of the Democrats are saying. Again, let's see if it goes into effect. People had said he wouldn't do this right before the Super Bowl. Guess what? Here we are.
About half of vegetables and 40% of fruit imports come from Mexico. Numbers are pretty staggering.
Cherry tomatoes, that's going to be hit hard. Avocados, that's going to be hit hard. Toy trucks, you might want to load up on toy trucks if you want to get ahead of some of these tariffs. PSA this morning.
Thank you. Who's that for? The children that might be watching?
Correct.
OK.
Joey?
The 5-year-olds out there that are very, very angry about their toy trucks.
Get your tonka now.
I hear you. Equities, right, down by 1.6% on the S&P. I've mentioned some movers, the automakers, the ones to watch. Sliding this morning ahead of Trump's tariffs, Volkswagen and Stellantis leading declines in Europe, with exports from Mexico under threat. Stateside, shares of Ford and GM under pressure. Wolf Research expecting tariffs could add $3,000 to the price of a new car. Here's another stat for you. Airbags and seatbelts, nearly 80% of imports come from our neighbours.
This just shows why General Motors in particular is in such a precarious situation. And GM shares already are down 7% so far this year without this pre-market move that we're seeing today. I just wonder from a political standpoint, do you really want to do this to Detroit? And that is where some people are questioning the popularity of some of these moves. And what happens if you have some of the epicenter of swing states that went for Trump seeing their businesses really hammered? I just think about that in particular with these companies that are getting hit some of the hardest.
It's a very integrated supply chain when it comes to the automakers between Canada, the United States, and Mexico. Cheap labor in Mexico, cheap resources in Canada, and highly skilled labor in the United States. And when you look at car components, sometimes they cross the border 8 times going back and forth before they get put into the car and then go to your dealership. How much is that going to cost? 8 times, half a dozen times going back and forth across a border with this 25% levy?
These calls are so important later on today. This market hasn't capitulated. We've talked about that repeatedly. Jay Pelosky made the point that this isn't shocking. It's not surprising. It's not shocking or surprising because he said it repeatedly on the campaign trail. But do you believe that this is the market reaction to 25% tariffs on Mexico and Canada? Do you believe that this is the market reaction on 25% tariffs if you're looking at the automakers, GM, Ford and Stellantis? Because I would have thought if you truly believe this holds, those moves would be much bigger than that.
Pretty much everyone would agree with you, I would argue. And you can see that from all the analyst notes saying that they expect them to be walked back. DataTrek, Nick Colas, put out a report. He took a survey on January 31st to see how many people believed that the tariffs would even go into effect on February 1st and would be announced. It was some 38% of clients thought that they would be announced on February 1st. This market has categorically rejected a lot of what Donald Trump has said as simply rhetoric, not fact.
And to some extent this morning, still, even with these moves, continues to look through it. So Colombia folded, and to some extent, Panama has as well, offering some concessions to the United States after a visit from Secretary of State Marco Rubio. The country promising free passage for U.S. warships through the Panama Canal. The country also vowing to leave China's Belt and Road Initiative.
So Mike Waltz, the national security advisor, took to Twitter and said this is a step in the right direction. I think it's a pretty big deal that Panama, after this one visit from Secretary Rubio, is saying we're going to pull out of Belt and Road. We're not going to reinitiate Belt and Road after 2026. We might even pull out sooner than later. And this comes as Rubio wrote in the Wall Street Journal that basically in the realm of diplomacy, this means paying closer attention to our own neighborhood, the Western Hemisphere. He's on an entire push in the Western Hemisphere, and he started with Canada, and the whole idea here is push China out.
So in November, I was in Peru. I was for APEC. China's presence was palpable all over South America. This is the opening salvo of saying, hey, wait a second, maybe not in some of the strategic areas. Very curious to see how much further that goes.
Some big pushback here, that's for sure. Let's turn to Mike McKee, our economics and policy correspondent, for the latest on these moves. Good morning, Mike.
Good morning, John. We know you're going to pay more money, and I know you were talking about what Mr. Waller thinks down at the Fed. It's a question of how long these tariffs go and how they're applied over time. Because while the president's putting on 25% tariffs on Canada and Mexico, and Americans will pay that, they won't pay 25%. Importers are charged at the border. They can absorb some of that. They can, if they want to, and then the rest gets passed on to you, the average American who buys the product. But it depends on what products you buy and over what period of time. Now, imports will get cheaper because the dollar's getting stronger. So U.S. companies may also raise prices. We saw that with the steel tariffs, and that means more you got to pay on this end. Also, you have companies like Irving Oil, which owns a refinery in Newfoundland. They say they're going to pass 100% of the tariffs on to their customers in New England. The other thing to keep in mind is that we all pay for some things all the time, but you don't buy a car every day. So the impact isn't as straightforward as it seems. Most analysts at this point think that Americans are going to be paying about $800 to $1,200 more a month because of these tariffs. Now, these are just on Canada and Mexico and to an extent China. It's not Europe. It's not the rest of the world yet. And he says those are coming. And we've looked at some of the projections from Wall Street analysts. Goldman Sachs thinks we'll see about 0.7. Morgan Stanley a little bit less than that. Bloomberg Economics also 0.7. That's what it's going to do to inflation, just these tariffs. And GDP, you can see there's a wide range of estimates from a 0.4 hit to GDP to a 1.2% hit to GDP. It really depends on what you buy and when you buy it going forward.
And if it stays on. And I've read the same notes, Mike, and they all say the same thing. This will happen if they stay on. And Goldman Goldman made the point, Jan Hatzius and the team over the weekend, that maybe this will be short-lived. Let's continue the conversation. Kellyanne Shaw, the former senior White House trade advisor to Trump, writing, "This is a high-risk, high-reward proposition. If it works, I would expect this to mark a new era in US foreign policy, one in which a broader set of economic tools are on the table." Kellyanne Shaw joins us now for more. Kellyanne, welcome to the programme. I just want to go back to the first term, because I think we all familiarised ourselves with Section 232, national security, 301, unfair trade practices. This was new over the weekend. They used the International Emergency Economic Powers Act. Kelly, what do people need to know about the use of that tool and whether it might be challenged?
Yeah, thank you so much for having me back on this morning. It's certainly an interesting Monday for any company who's operating in the United States, Canada, Mexico, and China, or have supply chains in any one of those economies. So IEEPA, right? This is the first time that a president has invoked tariffs on the basis of a national emergency. And IEEPA is a national security authority. It is different than 232 or Section 301, which supported the steel and aluminum tariffs and the China tariffs. Those had an investigation that made findings about the threat of imports or discrimination or unfair trade practices. This is about a pure emergency and national security issue, which the president has identified as fentanyl and illegal immigration.
So, Kelly, when the national security threat is resolved, what happens next? Do the tariffs get lifted?
Well, presumably. And if you look at the 3 executive orders that the president issued on Saturday, the legal basis for expanding the national emergency is the illicit flow of fentanyl and migration. So when those issues are addressed, presumably the legal basis for sustaining the tariffs would no longer be there. So my expectation is that these are tariffs that are targeted towards this national security issue, and that as soon as Canada, Mexico, and China and the United States are able to agree on a resolution, that the tariffs would go away.
Kellyanne, having been in the room, what is the chances that this gets resolved today and there's an 11th hour agreement before midnight?
Well, there's always a chance, right? I mean, this is a negotiation. The United States is requesting something from all 3 countries. And we have a call set up with Prime Minister Trudeau, President Sheinbaum today, with the president directly, which I do think is a good sign, right? These conversations have progressed to the top. And what was striking to me on Saturday, following the president's announcement and the issuance of these executive orders, was President Trudeau's press conference, in which he said he had not had conversations with the president all week about this specific issue. So I do think that a call is trending in the right direction, but whether or not what Canada and Mexico offer the United States is enough will be a decision by the president and the president alone.
In the meantime, markets aren't responding as much as some people would have expected. That could change should the tariffs go into effect tomorrow and continue for the foreseeable future. Neil Dutta put this out of Renmac. The most important thing is that Trump has said is that he doesn't care what the markets will do in response. Based on your time with President Trump, how much do you think he cares about the market's response?
Yeah, I mean, the markets are certainly something that the president watches very closely, but he watches a number of numbers every day. So he had 126 all-time highs of the market during Trump 1, which he was very proud of. He also watches the jobs numbers, inflation, the trade deficit, and other economic figures. But I think what you're seeing play out right now is the president's emphasis on border security. And he ran, of course, on the border and on inflation. And he is taking extraordinary steps to do something to tackle the number 1 priority, which is addressing the illicit flow of fentanyl and illegal immigration. And he is willing to take the punch. And I think you saw that in his comment on True Social yesterday, as well as a comment he made to a press gaggle that there may be some pain here. So again, I think he is prepared for that, for whatever the markets might do. But once again, these tariffs are designed to be short-lived, that they would result in an outcome on these national security areas of priority, and that they would not stay in place indefinitely. And I think that's how the president and his team are likely viewing them as well.
Kellyanne, to that point, if this is a border security issue and it does come down to fentanyl, how much does it make sense to you that Canada has the same type of tariffs as Mexico, given the disparity in fentanyl imports from that nation?
Yeah, and I think if you look at the executive orders themselves, the one on Canada actually addresses this point. And it makes the point that the challenge is primarily at the southern border, but that there are Mexican cartel activities that are now happening in Canada, and that there are other things that the president is seeking in terms of concessions from Canada, in terms of addressing some of the illegal flow of fentanyl. So I think this is a stick. It is not a scalpel. He is certainly taking a maximalist approach to both Canada and Mexico in terms of this 25% across the board tariff. But this is something new. We have not seen this in modern U.S. history in terms of using tariffs and tying tariffs specifically to these national security objectives. But you're seeing it now, and it's partly experimental, and we'll see how it plays out.
We will see. Kelly, appreciate your time as always. Thank you. Kellyanne Shaw there, the former senior White House trade advisor to Donald Trump. Equity futures right now, I realise a lot of you are tuning in just to work out where markets are. We're down by about 1.7% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Donald Trump's tariffs on major U.S. trading partners have led to a sell-off in cryptocurrency markets, with smaller tokens experiencing steep declines. The crypto market's total value has slid by about $360 billion so far today, with Bitcoin holding up better than the other tokens. Meanwhile, President Trump said the U.S. will halt any future funding to South Africa because of its new land expropriation law. The law allows the state to seize private land in the public interest, and in some cases without compensation, Trump claiming it would lead to the confiscation of land and mistreatment of certain groups. And Rory McIlroy won the AT&T Pebble Beach Pro-Am in California. He shot a 6 under 66 yesterday to win his first tournament of the 2025 season, which included an ace from 119 yards out. He won the tournament by a 2-shot lead and took home the $3.6 million prize. That's your Bloomberg Brief. John?
Yahara, thank you. 2 rounds of flawless golf over the weekend. 27th PGA Tour win for Rory McIlroy. It's good to see him back.
All I can say is that was Jonathan Ferro's moment of zen.
That was therapy for me over the weekend. Pebble Beach is beautiful. Have you seen that golf course?
It is beautiful.
It's gorgeous.
You're reliving that therapy this morning.
Just absolutely gorgeous. I knew what was coming Monday morning. This is it. Up next on the programme, tariffs complicating the Fed's path forward.
We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be.
I think it's fair to say they've been articulated. That conversation continues. From New York, you're watching Bloomberg Surveillance. A quick check on stocks and bonds. Stocks down across the board. We're off the lows, but it's not pretty. We're down by 1.7% on the S&P 500 in the bond market. And we'll spend more time on this in the next hour. Yields are up by 4 basis points at the front end. They're down 4 on the long end on 10s. We're back to 450. Watch that space a little bit later. Under surveillance this morning, tariffs complicating the Fed's path forward.
I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be.
So here's the latest this morning. Tariffs casting doubt on further Fed easing. Bloomberg Economics predicting the levies could add about 0.7% to core inflation. Joining us now to discuss is the former St. Louis Fed President, Jim Bullard. Jim, welcome to the programme, sir. So the Fed chair wants to wait to see the policies to be articulated, and I think it's fair to say they have been over the weekend. So, Jim, from your perspective, in your time at the Fed, once they've been articulated, did you just assume that they stay?
Yeah, I mean, this is one salvo in a trade war, and I think there's much more to come in various directions. This is mostly based on the fentanyl issue and the immigration issue, so it does seem like the 3 countries that are affected could take actions on those dimensions, and this phase would get ended. But obviously, the president campaigned on a trade war, and I think there's far more uncertainty in the future.
How much of a template, Jim, is 2017, 2018 in terms of the inflationary impact of Trump's tariffs to now when there are more goods being tariffed, but also there is a greater degree of inflation already baked into the system?
Yeah, I think the lesson from 2018 and 2019 was the GDP effect and blanket tariffs across the board of 25%, which were met by other countries, would have a big impact on GDP. And I think that would dominate everybody's thinking about it. The inflationary impacts, if they're there at all, would be a one-time effect. It would be relatively minor. And that's what happened in 2019. The economy slowed down precipitously, and the Fed actually reduced rates. And I advocated for that at that time as the right response.
Back in 2018, 2019, I knew what the Bega would cost me. I knew how much gas was going to be. I had a sense of where prices were. Now, people don't have as much of a sense of where prices are to that same sort of granular degree. Do you think there is that risk that companies have the ability to pass along price increases in a much more direct and consistent way because of how conditioned people are post-pandemic?
Yeah, I mean, tariffs at this level are, you have to think about them a little bit differently. I mean, you go into the bar and there's a bunch of beer for sale, and the Canadian beer costs 3 times as much as all the others. I suppose you're going to buy one of the other ones and maybe not buy the Canadian beer. So I think prohibitive type tariffs just shut down trade altogether. I think for cars as well, maybe it's not a good time to buy a car if it's going to cost $3,000 more or $6,000 more, the kinds of numbers people are tossing around here. They can delay those types of purchases. So there's all the substitution that occurs with tariffs at this level.
Trump is also talking about putting tariffs on the European Union. So can you view this as a one-off increase in price level, or because he's talking about more tariffs, warning other countries that tariffs are coming down the pipeline, do you see this as an ongoing inflation threat?
Yeah, I mean, one way, so first of all, this order is about the national emergency on fentanyl and immigration. But if you just want to argue the economics, let's say with the EU, then I think it's what's the response of the EU going to be? A simple response would be for them to lower their tariff level to the average tariff level of the U.S. That would make a lot of sense. These are both big economies. I don't see why the average tariff level has to be all that different between the two places. And that's something that the president has argued for. And it seems like maybe now is the time to think about that. Why not have the same average tariff level in the two places?
Jim, is there any reason why the Federal Reserve wouldn't just look through any short-term inflation shock? Any reason to believe they'd be nervous about second-order effects in this building?
Yeah, I think, as we've talked about many times, inflation expectations are a critical thing. They have been going up a little bit, 2-year tips up a little bit. So I do think that's a little bit concerning. But as I say, I mean, the lesson from before was that the growth effects are large or can be large, and that would tend to dominate any one-time increase in the price level.
Hey, Jim, appreciate your time, sir. As always, Jim Bullard there, the former St. Louis Fed president. Maybe some of that's getting picked up in the bond market with yields down at the long end, Lisa, and slightly elevated at the front end.
The whole concept of bear flattening, right? That in the short term, yields go up, long term, reducing growth, with the growth impact, the growth hit being the dominant thought that Jim Bullard had.
Were you looking to see if Canadian beer's on sale?
No, I was actually looking at the 10-year, but
look,
right. If Canadian beer, okay, but maybe people really like Canadian, beer
Who drinks
from Mexico.
Canadian beer? Is that a thing?
I think Josh Wingrove.
Does he? Find out. All right. Up next, Katie Kaminski of AlphaSimplex, James Picariello of BNP Paribas Exane, and Stephen Stanley of Santander, Earl Davis of BMO on this bond market. Up next.
This is frankly nuts. Canada and Mexico are our two largest trading partners.
The signals he's sending suggest that he sees values in tariffs above and beyond even their negotiating leverage.
There are near-term inflation effects when you're implementing tariffs.
It could change on a dime, but I think once they're on, then it's harder to take them off.
We think that this could actually be highly disruptive to supply chains, potentially inflationary because of that disruption. This could weigh on growth and inflation in a more meaningful way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Global equities heading south. 25% tariffs on Mexico, on Canada, an additional 10% on China. We are down across the board going into the opening bound 90 minutes away. Equity futures down by 1.7% on the S&P, on the Nasdaq down by close to 2%. On a Russell, negative by 2.35%. In the bond market, the next stop for this Federal Reserve is March 19th. How long will these tariffs last? Will they still be on when they get together the day before on the 18th? And they need to put together some forecasts at that meeting too. Yields are up at the front end. They're a bit lower at the long end.
What I think is actually going to be most compelling is what Jim Bullard, formerly of the St. Louis Fed, just had to say. He sees this as a greater growth shock than it is an inflationary shock. If that's the case, and we're seeing the hints of it in what's going on with the yield curve, does this actually indicate that the Fed can't cut rates and then that a downturn is more likely than some sort of resurgence in inflation?
In the FX market, as you might expect, the dollar stronger across the board against Canada, Mexico, and against the euro as well. Later on today, there will be a conversation between the President of the United States and the leaders of Mexico and Canada. What can they do to stop this from happening?
Well, we don't know yet. Trump did not offer an off-ramp or solutions that can assuage his concerns on why he's bringing up these tariffs in terms of national security issues when it comes to illegal immigration, it comes to fentanyl. He did say, though, after he said he's going to be getting on the phone with these leaders, I don't expect anything very dramatic. We put tariffs on, they owe us a lot of money, and I'm sure they're going to pay. We will also hear from Mexico's president at 8:30. She's talked about this Plan B. Potentially we'll get details on what that means.
I think Mexico's different, and it's different because of foreign policy and what could happen next. Just follow the road of where things are going right now. First move from this administration, they get into power and they start talking about putting a terrorist designation on the cartels. Then over the weekend, they accuse the Mexican government of providing a safe haven for those cartels. Things are ramping up beyond just tariffs between Mexico and the United States.
And Pete Hegseth has pretty much said that all options are on the table, including a defense option out of the DOD when it comes to these cartels. And where's he going today? He's making his first trip to the southern border as the head of the Pentagon.
That's one to watch. This is what you've got to watch this morning in the next hour or so. Coming up, we'll catch up with Kaminski of AlphaSimplex. A stock slide on Trump's tariff threats. James Picariello of BNP Paribas Exane on the outlook for automakers. And Stanley of Santander on the Fed's next move. We begin with our top story. President Donald Trump slapping 25% tariffs on Canada and Mexico and 10% on China. Elsewhere, Trump doubling down, renewing his threat on Europe. Our team coverage starts right now. Bloomberg's Tyler Kendall at the White House. Bloomberg's Mike McKee standing by for more on the economy. Tyler, those calls between the President of the United States and the leaders of Mexico and Canada, do we know when they take place?
Well, we're waiting for further guidance from the White House. We've yet to get their official schedule. But, John, it's interesting to look at as President Trump is rolling out these tariff plans, and he's broadly using them on this wide basis, right, as this all-in-one solution to tackle his immigration priorities and also rebalancing trade. But new questions about whether or not this could hit one of his biggest campaign priorities, which has to deal with tackling inflation, considering that he told reporters last night that Americans can expect to feel a little bit of pain. Bloomberg Economics saying that while the immediate impacts might come right off the bat, that consumer spending will likely see that squeeze over the medium and long term. Whether or not that could ramp up pressure, particularly as we see some retaliatory impacts from Canada targeting some Trump allies and also Republican states, remains to be seen.
Mike, when it comes to the impact of these tariffs, we just talked to James Bullard, who was talking about the fact that he sees more of an impact on GDP than inflation. So does the Fed just look through in terms of inflationary concerns and potentially as just a one hit?
Well, the Fed looks through it right now. The idea is that it would be a one-time hit to the price level if this were it, which is one reason that the Wall Street economists who are penciling this out are pretty much in agreement on what we're going to see in inflation, around a 6 to 7/10 boost to PCE. But if he puts tariffs on Europe or the rest of the world, then that just adds to the whole thing. Growth, as Jim said, is going to be a bigger issue because it takes it's a longer period of time in which you buy these things. So there's a wide dispersion between Goldman Sachs, which thinks we'll see growth down about 0.4, and Bloomberg Economics, which thinks it could be as bad as negative 1.2%.
Mike, at a certain point, the dollar strengthening offsets a lot of the potential inflationary impacts. How much are people looking at that as one absorption tool, that the depreciation of other currencies can really take on a lot of the increase in potential prices?
Well, that is the main argument that Trump administration officials are making for why this won't hurt Americans all that much. But you have to remember the dollar has been strong for some time, so the movement that we're going to get may not be that great overall from these tariffs, and that might keep things a little bit less good news for overall American people.
Mike McKee on the latest. Thank you, sir. Alongside Tyler Kender. Watch this space. We'll catch up with Tyler hopefully a little bit later. We're waiting for those calls between the President of the United States, Donald Trump, and the leaders, of course, of Mexico and Canada. Also follow what the leaders of the provinces across Canada are doing as well. So this comes from Ontario. The Premier, Doug Ford, commenting in a post on X, saying the following, that they will ban US companies from provincial government contracts, and also going on to say, and I think this could be a space to watch, ripping up Ontario's contract with Starlink. Is that going to be the perceived weak spot of this administration, going after the companies of Elon Musk?
Potentially it's a vulnerability given the fact that Elon Musk now has an office in the old executive building. He's very close, has this proximity to power that no other executive has when it comes to Donald Trump. So maybe this is a way they can try to needle their way into the Oval Office. Interesting, Doug Ford has been for the past 2 weeks sporting a hat that looks like a MAGA red hat, but it's blue and it says Canada is not for sale.
What's interesting is it's all trying to appeal to potential factions that could influence Trump. It's going after red states and products there. It's going after Elon Musk. It's almost as if Canadian leaders are saying, where are the adults? Someone rein him in. This doesn't make any sense. Why can't you get on board? And so they're going after very specific people who could potentially get Donald Trump's ear.
We saw this playbook from China back in 2018 and beyond, didn't we? Is it going to work this time?
Right now, it seems like maybe down the line, but right now the market's not responding in a way that could really foist that pressure potentially on some of the allies of Donald Trump.
I would say China's still using that playbook. It was just a few weeks ago that we reported that it was Elon Musk that China thought would be a good shepherd to take on TikTok, hand-picking someone that they have a tremendous amount of business with when it comes to Tesla.
Just to confirm, that headline we just got across the Bloomberg terminal, Ontario government cancelling its contract with Starlink. That's one to watch. One to watch also in the bond market. Check out what's happening with 2-year, 10-year and 30-year yields. So far on the session this morning, yields are up at the front end. They're a little bit lower further out along the long end. Katie Kaminski of AlphaSimplex needs to explain just what is going on. Katie, let's get to it. Let's start with the long end. Is this bullish or bearish for bonds?
I would say it's definitely a bearish signal in the sense that you're seeing risk off today. So when I'm thinking about the bond market today, I'm thinking about the market reacting to concern, to fear about inflation, to fear about just sort of the impact of these tariffs. So in theory, if we worried about inflation, we'd expect yields to actually go up. But I think the short-term response is fear. It's people buying long-term debt because they're concerned about the trajectory of the equity market right now.
At this point, Katie, do you think that this market seems more concerned about a growth shock or an inflation shock based on the trend lines that you're looking at?
This is actually a really, really tough question. And the reason I'm glad you asked it is that that's what we're trying to figure out right now is that, is it inflation or is this going to be something that actually impacts growth if we have sort of enough negative impact? So I think right now, just looking at how market reactions cross asset today, the biggest theme is risk off. But that doesn't mean that over the next couple of days, as we start to parse through the implications of this, that might shift somewhat more to a growth narrative. What's the impact on growth?
My head is trying to grapple with all of the implications here. One of them, and the dominant move, has been strong dollar, consistently across the board. Do you see that continuing at a time where if the dollar continues to strengthen, that becomes a headwind to international companies in the United States. It becomes a headwind to earnings. It becomes a headwind to some of the exceptionalism that people have been talking about.
Definitely. And, Lisa, what's really interesting is if you look at the dollar over the last couple months, we actually were worried about, geez, this trend has already gone so far in the US dollar. The US dollar is up so much. And then having the reaction that we had today, that's going to put the dollar in an even more favorable position, which is going to make things very expensive for purchasing in dollars. And it's also going to impact commodity prices globally. So I think in some sense, there is going to be a pressure point if the dollar goes far enough that it actually has a big impact on sort of export and demand.
Katie, when you look at market reaction this morning to these type of tariffs, 25% on Mexico and Canada, as well as 10% on China, but they're only going to happen after midnight tonight. Do you think the market is pricing in an 11th hour deal?
It's possible. I mean, I think what really is interesting to watch is that if you look at how the market has reacted to this news, it was much more extreme initially. So I think we're going to have to keep watching tonight. We might see a more extreme movements, but then things tend to subside. So I think there could still be some movement to come tonight. And that could be because people are hedging on whether or not there might be some side deal or some way to sort of negotiate around some of these decisions.
So where do you think people should look to hide?
Well, this is a good question. And I think where people are hiding is actually by buying the dollar and also by buying long-term debt as something to potentially hedge against the shorter-term impacts on the equity market if this becomes sort of the pain point that was already mentioned in terms of that it might cost Americans a little bit more. So clearly, fixed income in the short term seems to be the solution that the market's leaning to, and also the U.S. dollar and energy prices as well. So things that are going to benefit from inflation or protection.
Katie, I just want to gauge sentiment this morning. I'm not going to hold you to this. Do you think the next move will be a hike or a cut at the Federal Reserve, based on what we heard over the weekend?
Oh, this is a good one. I mean, because really, if this becomes a growth story and the growth story that Bullard was talking about, then I'd say no cut. But also, if we see inflation growing and we sort of have that threat, then again, no cut. But if we see detrimental economic impacts of these tariffs, then we might actually pivot to potentially having a cut for that concern. So I think that's where it's really tricky. There's multiple different avenues that we could go based on these decisions this week.
Katie, appreciate it. We're all trying to process the same thing in different ways. Katie Kaminski there of AlphaSimplex with the latest. I was saying earlier on that we'd like to hear from the NEC director. He has spoken to an American broadcaster just moments ago, and one of the headlines that came from that was, this is about drugs. It's about a drug war. It's not about tariffs. The issue is 100% about drugs, not about a trade war. Well, the issue with this, of course, is this is something they have to say because they used the International Emergency Economic Powers Act and justified this act by making it about fentanyl and the border.
Right, they made it about national security by using that act. And when you look at the fentanyl numbers from Mexico, this is a huge problem. This is something Trump has run on in his inauguration speech. He said he thinks immigration is the reason why he won, not when it comes to things like inflation, although obviously these tariffs could be inflationary.
It raises the question, what can Mexico do to have the tariffs removed and eliminate the threat? That prescription has not been laid out, and it's one reason why people don't understand what the off-ramp truly is.
If there is one, can we negotiate this? And we'll see if we can on these calls if they take place a little bit later on today. Equity futures on the S&P doing okay relative to the losses earlier on in the session. Around midnight, they were pretty steep. We're down by about 1.5% on the S&P 500. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Investigators have uncovered more information about last week's plane crash in Washington, D.C. NTSB officials told reporters that the Black Hawk Army helicopter was flying more than 100 feet higher than it was authorized. We also learned the unit was on a training mission to evacuate government officials in the event of a catastrophe. Meanwhile, President Trump's tariffs against Canada and Mexico are threatening production for automakers across North America. The duties would immediately hit almost a quarter of the 16 million vehicles sold in the U.S. each year. And Wolf Research analysts are estimating it could raise the average price of a new car by about $3,000. And a big night for Beyonce. She won her first album of the year at the Grammys last night for her album Cowboy Carter and became the first Black artist to win Best Country Album. Kendrick Lamar won Record and Song of the Year for Not Like Us, while Chappelle Rowan was named Best New Artist. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with James Picariello of BNP Paribas on the pressure facing the automakers, with GM down right now by 7%. From New York, this is Bloomberg. The opening bow 1 hour and 12 minutes away. Equity futures attempting to recover, but still down by 1.5% on the S&P, negative by 1.7 on the Nasdaq. On a Russell, your underperformance there. We're down by 2 full percentage points. That's the price action. Let's get you some morning calls. First up, Loop Capital downgrading FedEx to hold, highlighting further weakness in cross-border flows from tariffs. That stock down by 2.3%. Your second call from D.A. Davidson downgrading Lifetime Brands to neutral, citing exposure to recently announced tariffs and weak European profitability. That stock's down by close to 6%. And finally, Piper Sandler downgrading Constellation Brands to neutral, noting pressure from President Donald Trump's tariffs. Another stock, another name that's down by about 4% in early trading. Let's turn to the autos. US car makers slumping in pre-market trading as they prepare for the impact of Trump's tariffs on Canada, Mexico and China. James Picariello of BNP Paribas writing, we can be looking at a total tariff cost of about $46 billion. And we get to an average price increase of $2,900 per vehicle. James joins us now for more. James, it's good to see you. Thanks for dropping by.
Thanks for having me in.
Let's go with that 2,900 number, okay? How much of that is going to be passed on to the end consumer? Just assuming for this conversation, for the purpose of this chat, that these tariffs will hold, they will stick.
Yeah, so 40% of that 2,900 will be supplier costs, so supply chain costs. And the few suppliers that have reported their earnings already have discussed the tariff topics, the topic of tariffs, and have said they need to pass that on to their customer, the automaker. And so, of course, the automaker's left with this decision of, I mean, they're going to have to try to pass on whatever costs they incur. Now, the interesting thing is, I mean, a $2,900 price increase, you add on the 10% tariff levied against China auto parts, that's another $100 per vehicle, so you get to this clean $3,000. The only reason why the industry grew their U.S. sales in 2024 was because OEMs started to discount their pricing through incentive spending. And, you know, to think that now for 2025, we're conceiving price increases, I mean, there's almost no way that the industry would be able to sustain growth.
General Motors has been hit hardest. It's already down 7% so far this year. It's now down about 6% in pre-market trading, actually now almost but I'm curious going forward about what they could do to potentially offset this tariff risk at a time when Mary Barra said that she does have a game plan, but hasn't outlined it.
Yeah, it's really the linchpin there is going to be excess U.S. capacity, right? The average capacity utilization for a U.S. automotive plant is 65%, 63% to be exact. So there is a lot of excess capacity at existing plants. And I think the negotiating lever will have to be OEMs committing a portion of their Canada and or Mexico production, bringing it back to the U.S. I think that's the only negotiation chip that the automakers have, because a 25% tariff truly, you know, it brings into the question, you know, an existential threat.
How much is that going to cost, though? Because the reason why they build these cars in Mexico is because the labor is so much cheaper.
Yeah. So it's a great question. So if we go through the 25% tariff rate with the OEMs not doing anything, with GM, let's focus on GM not doing a single thing, that's at least, in my calculation, $7 billion in tariff costs if they don't do anything. And then you add on maybe $4 or $5 billion of supply chain costs, right? So we're almost wiping out their entire EBIT under a 25% tariff rate. If they move, let's say, 300,000 vehicles from Mexico into the U.S., which would be about half of their total imports from Mexico and Canada, That would be the major cost differential would be labor, and that's only $1 billion. We say only $1 billion because we just walked through wiping out almost their entire EBIT.
James, you just said an existential threat if it stays on. I mean, I've got to ask you the question. Are you suggesting that if we kept these tariffs, one of these companies is going bust?
Well, what happens first? A tier 2 or 3 or 4 supplier, a company name that that we don't know of, goes bust, right? And it just takes one component, one subsystem to throw a wrench, throw a bottleneck into the entire production lineup, right? So that's where it'll start, and then it'll cascade all the way up.
Is there a precedent for this?
Well, during Trump's first administration, the first, let's call it threat, was a 25% tariff, right? So we all imagined the rewrite of NAFTA, and that original threat was 25%. What ultimately happened there, right, we do have something to point to in terms of a favorable negotiation outcome between Trump and these two countries, or two partners. What ultimately happened was there was no additional tariff, and there was just a very manageable additional sourcing requirement in terms of the U.S. value add. Very manageable. No OEM has talked about it since. So, yeah, I mean, that's the president. The president is quite reasonable.
So ultimately, do you think that's what he's trying to do? Just bring up the renegotiation of USMCA?
Yeah, I mean, I imagine, he clearly wants more, right? Because USMCA, what we have now, the rewrite. He negotiated. So he wants more. And the 25% tariff will get every automaker with exposure to the negotiation table. I think ultimately, if you conceive, we import 4 million vehicles from Canada and Mexico. If GM commits 300,000 and a host of other OEMs commit a portion, right, you get to 1 million units, right, a quarter of total imports that now suddenly get moved to the U.S. I think the aesthetics of that would be a great win for the administration, and the costs are manageable to each automaker. Right? It's not a net positive, but they're manageable costs.
Have you still got an outperform rating on GM?
I do.
Nothing you said makes me feel like you've got an outperform rating on GM.
Well, I'm playing for the $1 billion additional labor costs, right? That's the manageable piece.
Is there an underlying assumption then that this just doesn't stay on? These tariffs don't hold?
That's the underlying assumption right now. Yeah, for sure.
Where would the jobs go if GM were to move some of the jobs from Mexico and Canada to the United States? What location, what states are those plants in?
Oh, I've got all the plants mapped out in my head. I mean, it would be a host of plants, right? One in Michigan. I'm forgetting the states, but I mean, there are 3 or 4 GM plants that produce the same nameplates, the same platforms as those that are produced in Mexico. So it would be a rather seamless transition, not cost-free, not interruption-free, because suppliers also need to retool for that additional volume. But again, it falls under the manageable.
Can I ask you a question that might sound really dumb? As an analyst, how long do they have to stay on before you change your mind that they're just staying on permanently? Would you revisit this in like a month, 2 months, 3 months?
Yeah, it's going to be an everyday thing. I mean, truly.
Day to day?
It's going to be a day-to-day thing.
Okay.
I mean, we're forced to be in that situation.
We'll be right here, market to market every single day. James, it's good to see you. Thank you.
Thanks.
James Picariello there of BNP Paribas Exane. It is difficult to make calls, given there are a lot of people out there that think that this can be negotiated away in the next few days.
That's been the previous precedent. There is no precedent for these staying on at this level.
Up next on the programme, we'll catch up with Stanley of Santander. And I know you've all got questions about the bond market. Just what is going on? Is it bullish or bearish for fixed income? Earl Davis of BMO, just around the corner. At some point today, there will be a call between the President of the United States and the leaders of Mexico and Canada. And it could move markets much more than a news conference with Chairman Powell. How this goes, one way or the other, we'll see. But right now, futures are down hard. We're heading south. We're negative by 1.5% on the S&P. On the Nasdaq, we're down by 1.7%. On the Russell, we're down by more than 2 full percentage points. With your morning movers, here's Manus Cranny. Hey, Manus.
Jonathan, that's the personification of the test of endurance. And therein lies the conversation you just had with BNP Paribas on GM. How long will these tariffs last? When does it push a double-digit drop in terms of earnings? That's the view from RBC. The worst-case scenario for Tom Narayan over there is a double-digit hit from tariffs, 21% on GM. To give you some context, a Chevrolet Montana costs $25,000. As of tonight, if these tariffs go through, that goes up by $6,250. What can GM transfer from Mexico into the United States of America? You've just heard it there from BNP Paribas. 3 main plants have the same assembly line and the same structure. Will it come to pass? Constellation Brands, when it comes to Mexican beers, Modelo, Corona, and Pacifico, imported from Mexico into the United States of America. What's the margin hit? Piper Sanders say that they moved to neutral from overweight on this. Again, this is the reality of the potential of tariffs on what you import from south of the border here to the United States of America. Now, NVIDIA, definitely under pressure, and if we continue on this trajectory, last week in the cash market down 15.8%. If you continue at this trajectory and pace in the cash market, there is a real risk that you re-enter a bear market. Pre-market, we very, very closely dipped towards that. A bear market from last Monday to this Monday, from DeepSeek to tariffs to chips, that is the consequence. Down almost 20%. Where's the YOLO? Where's the Momo? That's what I want to know. Amy Wu Silverman says the skew is very, very elevated. The market is racing relentlessly to buy puts and protection on the downside. Good morning.
NVIDIA was down 16% last week. It's down another 4% so far this morning. Manus Cranny, thank you. The focus of the world right now, with regards to financial markets and the global economy, very much on one thing: Trump's tariffs on Canada, Mexico and China, and the prospect of throwing some more at the European Union. Stephen Stanley of Santander saying tariffs are likely to be negative for growth, especially if there is retaliation. Stephen joins us now for more. Stephen, good to see you.
Good to be here.
Chairman Powell in the news conference said he'd wait to see policy articulated, and we've said this morning a few times that it has been. What does he do now?
I think you have to wait. I mean, I think this is a day-to-day thing. President Trump is speaking with the leaders of Canada and Mexico. There's at least a non-trivial chance that we'd never see these 25% tariffs.
On the margins, though, given that a lot of companies aren't sure what to do with this, Jim Bullard, the former St. Louis Fed president, was earlier on in saying he sees this as more of a growth shock than an inflationary shock. Based on everything that you've read and seen so far, would you agree?
Totally agree with that. Totally agree. So the inflation story's been the one that's gotten the most run in terms of tariffs. But the problem with that story is that tariffs are a one-time change in the price level, right? It's not a persistent change in the rate of change of prices, which is inflation. And so, in theory, the Fed is supposed to look through that. I realize easier said than done. But if you go back to 2018, I know very different economic landscape. But the main issue back then was growth, not inflation, and it definitely had a significant impact on growth.
The argument that people make against this is that the U.S. economy is so strong, and this is such a minor hit, that the U.S. will power through it, and it will barely show up. Why do you disagree?
Well, we may very well get through it. I don't think this would necessarily be inflationary, given that the economy does have a lot of momentum. But I do think that the growth hit would be significant. We would notice it for sure. And I think, again, if you go back to 2018, 2019, it seems to me that the biggest takeaway from that experience, at least for me, was it wasn't so much the tariffs themselves, it was the uncertainty in the environment that it engendered. And I think a lot of businesses were, taking a step back until they had a better idea of what was coming at that time. And now I think businesses are already in that mode. They're waiting for tax changes, regulatory, in addition to tariffs. And I mean, if I'm a business person, I'm not making any, I'm not making any big decisions anytime soon.
The other side of that growth, though, is what if there is a 15% corporate tax rate if you produce in the United States? Right? Isn't that the carrot and stick approach?
Well, this is what the president is aiming for, is he wants to bring production home. I think that's realistic perhaps for some industries and not so much for others. But yeah, it is a mix. I think that if you look at the administration's proposed policies in a totality, the tax piece and the regulatory piece are likely to be very positive for growth. And then on the other side, you've got tariffs and maybe to some degree immigration. He's leading with tariffs, which it seems to me maybe not the right way to go, because that's the one that has the potential to be negative for growth. But, we'll see how that plays out. I think it's I'm not a political analyst, but my sense is that for him, this is all a negotiation. The point of this isn't to slap tariffs and slow the economy down. It's to get what he wants from Canada, Mexico, China, and others.
And he's flirting now with the European Union. Last night he said it'll definitely happen with the European Union. So in that sense, how do you model all of this if it's basically just going to be paralysis, businesses waiting on the sidelines? Because they could be waiting for months or years.
Yeah, it's definitely a moving target. I mean, you think about, are the tariffs going to happen? Are they not going to happen? Then if they are, next question, are there going to be exemptions? Are certain industries going to get, which that happened a lot. And there were a lot of exemptions in Trump's first term on the tariffs that were imposed. How do our trading partners respond? Are they retaliatory? Do they want a deal? How does the broader economy respond? Do producers and retailers pass everything through? Do they eat some of the margin? There's so many questions that I think it's impossible to have a precise estimate. I mean, I think we know the direction, but I don't think the magnitudes are very difficult. You can kind of throw numbers out there, but it's all very tentative at this point.
Well, can we throw some numbers out there? Just a few. Let's go back to 2018 and talk about the experience from 2018. We know a whole different range of things can happen. Exporters can drop prices. We can eat it on the margin. It doesn't all have to get passed through to the consumer. You would be the first to say that's very dependent on what goods and what sectors, and I would agree with you. What did we learn from 18 about what corporations did then? What happened then?
Yeah, I think the difficulty is that the environment is very different now than it was then. I think back then, inflation expectations were incredibly low. Firms had very little pricing power. And I think in many cases, they were forced to eat at least some of the cost increases. This time around, firms have a lot of muscle memory raising prices when their costs go up.
Do they have pricing power right now?
We'll see. We'll see. I think that consumers are probably, the anecdotal evidence is that consumers have started to fight back a little bit. But at the same time, again, consumers also have muscle memory in paying higher prices. And, if it feels like tariffs is a good reason, then maybe they're more inclined to accept it now than they would have been in 18.
If we still have these tariffs by Friday, what am I looking at the payrolls report for? Is it of any use at all?
I don't think it's irrelevant, but I think it's definitely going to be the case that the markets are going to be paying a lot less attention to the normal data flow than they would have otherwise.
That's for sure. Stephen Stanley of Santander. Stephen, thank you, sir.
My pleasure.
Appreciate it. Let's get across to Mike McKee, our economics and policy correspondent. Mike McKee, that jobs report is just around the corner.
Yeah, you and Steve did a really good job of undercutting what I was going to say here about how important this week is, because as long as the tariffs stay in place, that's going to be the focus. And the idea, Steve was talking about, it's really hard to put numbers on this, is very important. We get some numbers this week that normally would be very important. We get ISM today, the manufacturing numbers, and then on Wednesday we get the services numbers. We also get ADP and, how people trade on that. And then on Friday, the payrolls report. But do these things matter at this point? Because the Fed is going to be watching tariffs as well as the markets, and they've got to figure out what the impact is going to be. We don't really have a good idea. Now, we do get a lot of Fed speak this week, so that's something to focus on, including your friend, Chris Waller, is speaking on Thursday. It's not on the economy specifically, but he might make some remarks. And then we get two from the vice chair, Philip Jefferson. So a lot to watch for this week in terms of the Fed and the economy. It's just a question of how much it's going to matter.
Mike, that's an important calendar. I agree with you. I really agree with you. Looking forward to Governor Waller later on this week, and let's see if we can get him to comment on what's happening with the general economy. Need to get some comments on this bond market. So the two-year yield right now is higher by 4 basis points. If you go further out along the curve, you'll notice that yields are down by a basis point or two on a 10-year, 4.52. Is that what you were expecting this morning? Let's cross over to Earl Davis of BMO, who has more. Earl, welcome to the programme, sir. I've asked this question a few times already today. Is this bullish or bearish for treasuries? Which one, Earl?
It's bullish for tips, not treasuries. And tips will outperform both on a rally, as we're seeing today in the 10-year sector, and they will outperform on any sell-off. The reason why it's hard to answer that question ultimately, other than tips, is that the market only has the ability to focus on one narrative at a time. And there's 4 possible narratives that could happen now. 1 is inflation, 2 is growth, 3 is risk off, and 4 is fiscal. 2 of those, inflation and fiscal, are negative on bond yields, and 2 are bullish. That's risk off and growth. The risk off is what we're seeing now, combined with the inflationary fears.
Do you think on the tax, on the fiscal, Earl, that actions like this make it more likely than not we'll get bigger tax cuts than some people expect?
Yeah, it could go both ways. There's so many unknowns. That's why we said our approach is, you know what, we expect nothing, but we plan for everything. And so that we could take advantage of it now. So it's possible, but there's so many unknowns, right? What is the revenue actually used for? How long does this last? So if it's a short-lived tariff war, then we can expect to see more pressure on fiscal. But if it's longer-lived, then yes, it does help to fund tax cuts and other spending choices.
Earl, do you have a base case going into this evening? Because after midnight, they're coming on unless there's an 11th hour deal.
Yeah, it's one of those things where, you hope for the best, prepare for the worst. So our base case basically is, and we don't have a base case, but it's to react to the market, to acknowledge when a narrative has run out. And I named the 4 things that we're looking at as possible narratives. If you were to ask me right now, the way I believe I see this going is, first you have your risk-off trade. You're seeing that through credit spreads widen. You're seeing that through a rally in nominals and tips, even though tips are rallying more than treasuries. So we'll have this risk-off first. Then if the tariffs are implemented and grow, there will be inflation fears. And the reason why I feel there will be inflation fears, COVID has conditioned consumers to accept price hikes faster. So I believe there'll be a rapid flow through of any price increases of tariffs into prices here. So you'll have that inflationary aspect. But as your previous guests seen, this is more of a growth shock as it stands right now than an inflation shock. So I think the second half of the year, you start getting that tremendous rally in bonds. So it's very interesting, the possible sequencing of this. One thing I do want to highlight, there's one thing where it changes this to an inflation shock from a growth shock. I do believe it is a growth shock on the real economy, but what changes it to an inflation shock is if you get money printing, if you get QE again, because that's putting more cash into the system, which will fuel the inflation and fuel growth. So it's one thing to watch out for where it could pivot from a growth shock to an inflation shock.
Earl, do you think it could be more inflationary as well if we get more tariffs? Trump last night is talking about the fact that they're going to be coming as well when it comes to the European Union.
Yeah, you know what? It's a very interesting thing. This is why I brought up QE. So if you think of the economy, U.S. economy, as a pie, the pie is not changing shape without any QE or QT. It's one solid size. Now you bring in tariffs. People have to spend more. So the bigger piece of the pie is now going for tariffs, that for inflation and to pay prices. That means there's less that goes into investment. That's why without QE, you do get a growth shock ultimately. But there is a very large potential. I think the trigger for QE or something more stimulative is the risk off. You start getting a big sell-off in risk assets. I do think the Fed put is in play, and that is adding stimulus to the market. So there's so many dynamics here. You have to, but there's opportunity as well. As long as you map it out and look and wait for the opportunity at the right time to strike, that's what we're doing, and I gave you the process of how we're kind of looking at it.
Oh, just briefly, though, do you think the threat, just the mere possibility of inflation picking up again, does constrain the Fed put, the Fed's bias to ease?
No, not at all. Fed puts in play. And the reason why is because we're not at the peak of inflation. We're not where we were in 2022. So they still have room. And the reason why it's in play is because of that potential growth shock. So they could say we're looking through this supply shock because we do see depressed demand, and we're going to address the depressed demand because we believe inflation will ultimately end up in the range that we want, that 1% to 3%.
Oh, you're one of the best. Really thoughtful stuff. Appreciate your time. Thank you. Earl Davis there of BMO. Big debate about what this means for the US economy and ultimately the Federal Reserve and, of course, US fixed income, the Treasury market. At the moment, and not my opinion, just based on the opinion of market participants and where things are trading over in Europe, there's no debate. This is just bad for growth and ultimately could lead to further disinflation. If you put the walls up in America and you have to eat the overcapacity coming out of China, it's the Europeans that will do a lot of that eating. Yields are down across the curve in Germany. The 2 year's down 7 basis points. The 10-year is down 6. And I think that speaks volumes on this morning, where there is some confusion about what it could mean for treasuries. I think there's very little confusion about what all of this would mean for the European bond market. Let's get you an update on stories elsewhere this morning. Let's cross over to Yahara Hackers for your Bloomberg Brief. Hey, Yahara.
Hi, John. President Donald Trump says he will have separate calls regarding tariffs this morning with Canadian Prime Minister Justin Trudeau, as well as Mexican President Claudia Sheinbaum. Trudeau has already pledged 25% retaliatory tariffs. Plus, Ontario's premier said his government is ending its contract with Elon Musk's Starlink. Meanwhile, President Trump's tariffs include plans to get rid of an exemption for packages worth less than $800. Retailers, including Temu and Shein, have exploited the loophole for years to quickly expand in the U.S. Critics say the flood of packages from China is hard to monitor and may contain illegal or dangerous goods. It's a trade most are calling the most shocking in NBA history. The Dallas Mavericks sent their star forward Luka Doncic to the Lakers for Anthony Davis. It's the first time in league history that two reigning All-NBA players were traded for each other during the middle of the season. That's your Bloomberg Brief. John?
Yahara, thank you. And thanks for this morning. I'm told by my producer, Jamie, this is the worst trade in NBA history.
Maverick fans are literally going nuts. They do not understand why they would do this trade. And for them, it makes no sense. Maybe we'll find out why.
Still struggling to make sense of it this morning. Up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg Surveillance. The opening bell is 40 minutes away. What a start to February. After closing out January with a decent month of gains, up by almost 3% on the S&P, on the Euro Stoxx 50 last month, up by about 8%. Massive rally in European equities. As you look at these moves, and we're down across the board on the S&P by 1.6, on the Russell down by 2.3, and you look at the losses in Europe, you've got to remember why we saw that outperformance in Europe. And yes, positioning was part of that story. But also, I remember the first week of Trump's second term, and we're sitting there in Davos, Switzerland at the World Economic Forum, and people are hopeful because we didn't get tariffs in the first week that we might not get them at all.
There was a feeling that this was a president who was willing to negotiate and not necessarily going to be as harsh. Today, that basically has been shattered. Just wait. And it's sort of a question of what can he get done sooner versus what he's going to get done later.
Well, he still may be willing to negotiate. There is a phone call this morning, and I think we should see what comes out, a readout out of that phone call. I mean, these tariffs are set to take place after midnight, and he's getting on the phone with both these leaders. So let's see.
You've heard the bullish argument repeatedly. Does it still stand? There is scope for negotiation. It's transactional in nature. It's constrained, driven by the equity market to some extent, and the backdrop for the economy is good. Does all of that still hold after the weekend's actions?
Well, some of the bricks have been taken out. I will say he did say that UK is immune to potential tariffs, which I thought was sort of notable. Not sure exactly how Keir Starmer got on his good list.
That's a Brexit win, Bramo.
But, okay, all right. Well, at the same time, Keir Starmer isn't necessarily... Well, anyway, we don't have to get into that. But it sort of erodes that argument. But I think Stephen Stanley's point about the uncertainty and how much that weighs on business confidence, as well as the strong dollar and what that does to corporate earnings, that might be the most salient story as we wait for more certainty.
The direct line was that the UK is out of line, but the European Union, they're an atrocity, according to President Trump. That's what he said last night. But I wonder, when you see the S&P 500 down 1.6%, is that enough for him to say, time to walk in and negotiate? Or maybe he'll look at that and say, well, they're not completely tanking, and actually double down on places like the European Union.
I don't know, but we did see a much bigger drawdown back in 2018. Much bigger drawdown than this. This is nothing.
People are treating this playbook like 2018, negotiating tool taken off. And that, I think, is really the key question. Is that truly the case? And if it's not, how long does this go on before you start to see some pretty major shifts? by corporate executives.
We are hitting the ground running to kick off the month of February and a brand new trading week. Your week ahead kicks off like this. Later on today, Annmarie said it, we'll have 2 calls with the leaders of Mexico and Canada and the President of the United States. That's it. They are the big ones to watch a little bit later. How much scope is there for negotiation? On Tuesday, if we don't get any of this sorted, these tariffs go into effect on China, on Mexico, on Canada. And then look out for this too. The Israeli Prime Minister Benjamin Netanyahu is visiting the White House. So that could be a busy day on Tuesday. On Wednesday, we get the ADP jobs report. We get some Disney earnings as well. On Thursday, another round of jobless claims, plus the Bank of England rate decision. Then on Friday, it's the major one. On Friday, outside of all the earnings, the jobs report is just around the corner. Bloomberg's Tyler Kendall joins us now at the White House ahead of the conversations between President Trump and the leaders of Canada and Mexico. Tyler, this is the big focal point for the market later on today. Ahead of those calls, you caught up with the National Economic Council Director, Kevin Hassett. What did Kevin have to say?
Well, John, I pressed him on what sort of benchmarks of progress Mexico and Canada would need to meet in order for President Trump to ease or lift these tariffs. And he said he didn't want to get ahead of the president's calls with the foreign leaders this morning, as we still await guidance and also a readout on what might have been said during those. But he did want to make clear to me that the administration says that they don't feel that this is a trade war. Instead, they feel this is a war against illegal immigration and drugs coming over the border. Now, when I asked him what sort of economic impacts that Americans might be feeling, particularly after President Trump told reporters yesterday that there might be a little pain, he said that he feels that inflation will go down due to supply-side shocks. It's clear that this White House is trying to bank on a boost to U.S. domestic manufacturing from these tariffs. But as we spoke about earlier in the show, not everybody agrees with that. The National Association of Manufacturers, which represents about 14,000 businesses here in the U.S., in a statement to Bloomberg News said that these tariffs will send ripple effects and severe impacts for all of their members nationwide.
Tyler, did you get a sense from Kevin Hassett if it is that last point, boosting American manufacturing, or it is using IEEPA, a national security concern? What is driving these tariffs?
Right. Well, as we've spoken about before, it's very clear that there's kind of this one-size-fits-all tariff when it comes to President Trump to address multiple of his campaign priorities, including rebalancing trade and also immigration. Now, the Trump White House is going to put forward that they are going to enact these under emergency powers and invoke this national emergency. Whether or not that holds up to legal scrutiny, we'll have to wait and see. But it is clear that they are trying to also paint this in a positive light for U.S. manufacturers. We saw, for example, some Republican senators get on board with that. Senator Bernie Moreno, an Ohio Republican, said that his state's open for business. Of course, they're a big producer of steel. While we're also watching some other senators. I got a statement from Senator Ted Cruz, for example. Texas is the largest trading partner with Mexico. He told me in a statement last night that he actually wants to see trade expanded between the U.S. and Mexico, that all the players need to come to the negotiating table for that to happen.
Tyler, appreciate it. Tyler Kendall there, Bloomberg's very own, outside of the White House. Tune in tomorrow. Dan Ives of Wedbush on tech. Lots of earnings this week. Sarah Hunt of Alpine Saxon Woods, the former Deputy US Trade Representative Sarah Bianchi, and Greg Deco of EY joins us as well. So the trade war begins. 25% tariffs on Mexico, on Canada, 10% levy on Chinese products. The big question this market's got, how long will it last? And will it even start? From New York City this morning, good morning to you all. This was Bloomberg Surveillance.